Hello and welcome to the official Singapore window. Now today what we had in Dubai was a small bounce on the physical premium, so we jumped back up to 63 cents having been at 49 on Friday. Now this is important because this week is one to really pay attention to with regard to the Saudi OSPs that will be coming out towards probably the end of next week for the next month, because they have previously used the final week average to set their OSPs, but that does imply that unless we see a significant strengthening this week, there would be a weaker than expected OSP. So that's one to watch. Already on the monthly average, we're 30 cents lower this month so far than we were last month. So in any case, looks like that we're going to get a cut. But in the window itself, what we had was really more of the same in terms of who's doing what. We have still Trafi and Totsa as the main buyers. Got 3 more convergence today, including the first Oman, which was declared by Vitol to Totsa. And really those two have dominated, as you can see from this list. They've dominated the buy side. We have got Glencore becoming a bit more active at the moment today. Also Hengli, which had been selling. You can see that they declared a convergence here to Trafi last week. They flipped to the buy side late last week, but now today they've gone back to selling again. So that's an interesting one to watch, because we've seen really this kind of variety of Chinese players. You know, you've got your Unipec, Sinochem, Hengli, etc. They've all been on the sell side. So Hengli's behavior has been pretty interesting. But yeah, we've got to 25 convergences there so far this month. So it's really been quite consistent, really. It's been quite a steady state window this month so far. And now that also kind of feeds into flat price, which, you know, this month has been pretty range bound. Throughout November, we've been kind of stuck in this $65 to $62 range, except for a couple of, as we can see here, except for a couple of little dip peaks above 65, which you have like here and here, but they haven't lasted long. We're really stuck between the 62 level here and the 65 level up here, and it's been pretty kind of sideways throughout most of the month. But one thing to keep an eye on is really this futures spread, this prompt futures spread for Brent, because we've got to over 60 cents again, and that is extremely strong given the physical structures are pretty weak in both Dubai and Data Brent. Remember, Data Brent physical differential is still negative, even though it's been strengthening significantly over the last week. So this futures strength is really kind of disproportionate to the physical spot market. Likewise, Dubai, you know, this is the Balmo M1 Dubai swap spread, 20 cents relative to Brent is very, very weak. So that divergence between the two crude benchmarks is really continuing. And I think really what we're looking at the moment is the Russia-Ukraine negotiations. And I think flat price is going to wait until we see some kind of solid development there, something concrete, before it can make some kind of really violent correction, either upside or downside. Downside may look more likely, though, if we get towards a peace agreement. So stay tuned, and we'll bring you those news as we get it.
Hello and welcome. This is the first and the only magazine show with the latest news and information from the UK energy scene. Oil or diesel, wind or solar. It's all here in the next 30 minutes. On the show this week, will COP30 actually achieve anything? We report on some nascent plans to create a roadmap for the world to abandon fossil fuels. The UK Energy Secretary Ed Miliband saying it can be done. Ukraine is hitting more and more of Moscow's oil refineries. The price of Putin's oil is falling. What will that mean for UK fuel prices? Are they going to come down? And North Wales will become a beacon in the golden age of nuclear, says the government. Plans are announced for the UK's first ever small modular nuclear reactors. They're being built by the publicly owned Great British Energy. Joining me now to discuss the week's events, Greg Newman, the Chief Executive Officer of Onyx Capital Group, and Julian Keyes from Flux Markets. Gentlemen, you're very welcome. Shall we start with COP30 and see what's going on there? As we get towards the end of the conference, the negotiating becomes a little more fraught, and the question hangs in the air as to whether anything of substance can be agreed. However, there is some optimism around a consensus on language about a roadmap for all countries to stop using fossil fuels. At a press conference on November 18, a spokesman for the French pressure group, Oil Change International, was in combative mood.
If we are to have a roadmap on fossil fuels at this COP that is useful, that is actually helping countries to transition to renewable energy and to full energy access, we need it to, first of all, be rooted in equity. So we need this process to grapple with the complicated question of who is going to phase out fossil fuels when. And not countries are going to be responsible for the same timelines. The second is we need to look at the enabling conditions, because we can't say fossil fuel phase out until we're blue in the face. But if we don't look at what's preventing a number of countries from getting out of fossil fuels, that's going to be for nothing. So we need to look at the finance. We need to look at the technologies. We need to look at the just transition. And this is part of the package. If there isn't progress in these negotiations on finance, in particular on just transition, on adaptation, a lot of countries will find it exceedingly difficult to agree to fossil fuel language. So let's not just look at the fossil fuel bit in isolation, but as part of a package for justice and for equity.
So a low-key preamble to COP30. It might be that a deal on this roadmap is possible, but the money, of course, will matter. Which countries contribute and just how much? How's your level of optimism, Greg? COP30 going to achieve anything, or is it going to go down to the wire as ever?
I think at least the Western nations, they're up against it because, of course, the US are so aggressively against the carbon emission narrative or cutting carbon emission narrative. And I think the CBAM, the carbon border adjustment mechanism coming in next year, I'd be very surprised if that doesn't come up, because that is, or if it doesn't come up, and there are some discussions around how to essentially raise more money for this, for UK to spend more money. I think the immediate political backlash would be like, and on top of that, we've got this carbon adjustment coming up next year, which is going to be very inflationary. So I think it's going to be very difficult. But I still think Ed Miliband will continue to be very positive about it. But I think when he gets home, he's going to be under the cosh, because as soon as people start to realize that things are going to get worse and worse from a cost perspective, I don't see how that's not backlash. But generic point of view, I guess.
The whole point of these conferences, Julian, I suppose, people do get carried along with the sort of groupthink that's prevailing at the time. As Greg was saying, the risk is you agree to something that's not practical or not possible or not doable.
Yeah, that's a really good point, and I agree. Affordability is on everyone's mind at the moment, right? This is why Donald Trump's not engaging with this, because affordability is right on the agenda, as he's finding out at the moment. So it's really important. I think you're right, Greg. Ed's going to come out with very positive things. In fact, he said that it is achievable with will and ambitiously within the next 10 years, yet to be seen. I think, having sat on this podcast for 3-4 weeks, it is so important to understand your electorate's appetite for change in cost. And right now that's nil. So it is going to be tricky. Last COP meeting, Azerbaijan last year, the countries agreed to put 1.3 trillion into the pot. So this time, the roadmap, this COP30, the output should be how are we going to mobilise and operationalise that. And I understand that is the focus, as we saw from the French oil change. I've forgotten his name. It is about equitability. It is about how we're going to unlock and operationalise this process, and that is tricky. I don't know the answer.
Who knows? We may still be talking about this next week because these things often overrun, don't they? Next, more information about the Ukrainian attacks on Russian infrastructure. Reuters is reporting this week that the Ryazan refinery, that's one of Russia's largest, has stopped a key processing unit. Elsewhere, Ukrainian hostility is impacting on the availability and the price of Russian fuel. But I suppose we have to wonder, what does that all mean for us in the UK? What's the latest market news as we record, Greg, on the Russian numbers?
Well, there's the Russian numbers, and then there's the diesel that they export, which is what I think is much more important for the UK to be aware of. So the prices, it's actually very ambiguous. Bloomberg have reported the prices being lower, $23 around that discount to Brent, which is an almighty discount, and it is low. But to be honest, if you actually look at how prices have risen throughout, slightly risen, it's not a huge impact from where we are, in my opinion. But of course, every dollar counts type thing. But on the flip side, we've had a very aggressive rally, as we call it, an increase in price in the heating oil and the diesel markets, which are very tightly linked. So that's on a relentless rise. I think gas oil is about $800 per metric ton. So that's quite a significant increase. And I think that is going to, well, I know it's going to lead to higher prices in the UK very soon. It's just whether or not it really goes for it, because you can see the Brent price and like the Russian price, like you just said, there's a headline prices and they can get reported, but you've really got to look at the diesel price, the outright price, and that can divorce quite aggressively from these headline prices, which it is. So bad because prices are actually increasing for us.
It's going to go up. And of course, as we record today, we haven't seen the effects of the latest American sanctions against Russia. They've still got to be factored in sort of starting next week, right?
Yeah, they actually come into full impact on the 21st, so
Right.
Friday this week, if my maths is right. And I think, just to reiterate, it is very asymmetric. So, yeah, the crude from Russia is trading at this substantial discount. To the casual buyer, they might think, well, that's going to impact my, I could buy diesel cheaper. But actually, we've seen, and looking at the graph here, we've got diesel prices here in the UK. They have significantly rallied towards the end of last week as a result. In actual fact, so we got up to, this is all in pence per litre. So this is £1.51 at the moment. And during the course of last week, we were £1.47. This is pump price, our recorded Flux pump price.
So you will see this in a couple of weeks at the pump, right?
Exactly. It takes, so if prices stay at this same level or go higher, we'll see that lag as people buy new stocks at their local forecourt. At current prevailing prices, this filters through because it takes somewhere between 10 days and 3 weeks to filter through.
But the buses fill up today, right?
Yes. And
as you see this program.
And I think we need to also underline, and we've spoken about it before, that yes, Russian crude has decreased, but if sanctions are really placed rigorously, and I mean sort of second level, that in the past, Russia and other countries that have been sanctioned work around these. They've got ways of obviating it, right? If that's not possible, we really will see these prices and oil prices go up quite
That's what I was
substantially.
going to add to this. So it's been a strange couple of weeks for the market because the sanctions got announced, and as Julian is describing, that is undeniably for the freely market traded oil is very bullish. We expect the prices to rise very aggressively. There's a lot of messing around. It was a big shock to the oil market, and actually the oil market participants generally, the traders, didn't fare very well. But now that's kind of coming to an end, and we've had bits of overhang, bits of glut, people talking about this and that. When they bite next week, the reality is going to bite in combination with diesel. It really is. The global market is eyes are on diesel, and sanctions will start to bite from next week. and it could get not just bad, it could get very, very, very bad. This is like 2022 levels. It's going to be very hard for people to understand because they say, isn't there so much oil around the world? It's like, yes, but you're talking about a very select
It's like
number.
perverse, isn't it?
It's very
There's a lot of oil around, but the prices are still going up.
And what you're going to see more of is as the prices rise, as we do, quite high conviction expect, you're going to get governments doing what they do in these scenarios like they did in 2022 and start to try and pull levers. So they might be saying, look, we can release some of our strategic petroleum reserve. And that's what the US did in 2022. They released 1 million barrels per day. But the thing is, they've done that and they didn't replenish it. So if they do it even more now.
So not a trick they can repeat.
It's not really a trick, or they could, but it just puts them under a hell of a lot of pressure.
Yeah.
And I think my personal view is, and this is hugely conjecture, but Trump's relationship with Saudi Arabia, he's always had a good relationship with them and encouraged trade. But I think you never know what's going on behind the scenes. And I think he's always been aware that if I'm going to put more pressure on Russia, I need cooperation with Saudi Arabia. But he's not an oil trader. I think he overestimates how much they can supply in lieu of Russian oil. I've stopped buying Russia, just buy Saudi. Saudi don't have that kind of spare
It's not that
capacity.
simple, is it?
Really not that simple. And even weirder than that, there's even for the US, who have quite a lot of excess, even they need to import some of Saudi because of the grade and things like that. So it's going to be a bit of a mess, we predict. And with these things, the most worrying part is every time we do something to Russia, it just makes it worse. But I think even if it was to make it better, I don't see them as a country or who can come to a negotiation table and within a couple of hours it's done. This is a negotiation that even if it's successful because of the sanction pressure, it will be years before something's negotiated. So I don't see a world where oil is not incredibly tight and highly priced, unfortunately, going forward.
Okay, let's talk about wind for a second. As we record this programme, Wednesday, 19th of November, we've heard this morning from the Chief Executive of Great British Energy, one of his first appearances, before the Scottish Affairs Committee in Parliament. Here's Dan McGrail being asked about the achievements of his new organisation.
I think it's a very positive, from an individual perspective, I think it's a positive idea to give people a stake in the energy transition. And from an energy sector professional perspective, I see the benefit of having an activist public investor to work alongside the private sector. And I think key for us has been to develop a strategy and engage with the market so that we can target how we are additional in our strategy and build it up. In terms of our first accomplishments and over the sort of the past year since the company was incorporated, the bill was passed in May. The statement of strategic priorities was published in September. So we've made good progress. Obviously, appointed a startup board, permanent chief executive. We've launched the solar rollout on schools and hospitals. And today we are announcing also, purely coincidentally, our first investment, which is into a floating offshore wind farm off the coast of Caithness in Scotland. And we're doing that together with the National Wealth Fund and the Scottish National Investment Bank.
So a first project for GBE coming along, though he does admit that in terms of wind projects, there are no indigenous British companies to favour. Of course, government authorities are always under pressure to try and give work to the British people if you can. Making of wind, the construction of wind farms, it's all done by other people, isn't it? Including the Chinese.
Yes, yes. I think we do have a lot of technology and industry. From what I've read, I can't respond to that directly, but I understand that we have 100, 200,000 jobs related to the renewable revolution that's built over the last sort of 10 years or so. But yes, to your comment, a lot of the infrastructure, the battery is related to China. And
there I had some other political worries about it.
Yeah, absolutely. And so it does can turn on its head the sort of idea of complete energy security.
Yeah.
Right?
On a broader point, Greg, this great British energy idea, it's an idea the Labour government brought in. Are you sceptical? Do you think it could work, or do you have your doubts?
Well, since the beginning, when we talked, we didn't really understand what they were going to do. And I still don't really understand what they're going to do. But I guess it's like they're kind of trying to guide the process. Is that the general philosophy of it? I mean,
yeah, they're an overall sort of providing energy, providing money, providing coordination, I guess, to get stuff done. That seems to be the ethos, anyway.
Yeah, I think it's about providing liquidity through public and also corporate finance. So both. And if they need to step in, I don't think it's about taxpayer funding. The idea here is to sort of get like PFI, that old sort of private finance initiative, redirecting investment into that directed. So, that's what it's about as I understand it. But yes, we need to see it operationalized, and we haven't yet really seen this. We're just starting to see it now, which is really good.
All right. Well, that's all that's happening this week. Any more charts for us at this stage, Julian? What have you got for us in terms of what's moving on the prices market?
Yeah, absolutely. We did just quickly look at the flat price, the outright price of pump diesel. In terms of what's really driving that, if we look at this chart, it looks almost identical, but it's really the difference between the cost of diesel and crude oil, the cost to refine crude oil into diesel, as traders call it, the crack spread. And that has really moved in reaction to the shutdown of some of the eastern refineries that are owned by Lukoil, and also this lack of up to 3 million barrels a day coming out of Russia that was coming onto the market. That's putting more pressure on that system. So, this is filtering through, as we saw in the previous chart, into pump price and diesel price, and also gasoline prices. And just quickly, as Greg mentioned just now, if we look at that top left-hand, number, that 144, that's the government price published today. The average pump price across the United Kingdom, so £1.44 pump price, and we're seeing prices here in our table here at the moment at about £1.53. So if prices stay at this level or go higher, pump prices will react. Tends to take 10 to 2 to 3 weeks for this to filter through. So 1 to 3 weeks to filter through.
Okay, Julian, thank you for that. This is the UK Energy Show, brought to you by Flux, the biggest news, information and trading platform for world energy markets, from Onyx Capital Group. Now, next, something brand new for Wales was confirmed by the government this week.
For decades, Wales led the way in powering Britain, and today we're leading again.
Right here in North Wales, we're building the UK's first small modular reactors, the start of a new golden age of clean energy.
Thousands of high-quality jobs, new apprenticeships, billions of pounds of investment delivered by Labour governments in Cardiff and Westminster, working hand in hand.
Wales will be at the heart of our mission to make Britain a clean energy superpower.
This is the power of Labour working together, delivering energy security, good jobs and a brighter future for every part of Wales.
Now, the government argues these small modular reactors will be an important part of the electricity generation mix. Others are not convinced. A campaign group called Nuclear Free Local Authorities says that SMRs are uncertain and unproven, and that power generation, in any case, from these things won't start until the 2030s. Oh, and by the way, the electricity created will be far more expensive than that generated from renewables. So, your take, gents, on small nuclear reactors, modular reactors. Are they going to work?
But I think anything that at least attempts to reduce the intermittency of renewables, just basically wind doesn't blow all the time. It creates a strain on the grid, because when the wind doesn't blow, they have to go and use natural gas. The natural gas traders go, thanks very much, rack up the price, and we end up paying way more. So anything that more reliably supplies the grid that isn't fossil fuels, that isn't in the hands of traders, should be a good thing. Obviously, this is an easy thing to say, but we should have had these a long time ago. So it's one of those things where you say it won't be done in 2030 till 2030, but that's probably what they said in 1990. I don't know. So I disagree with that logic. I think we need as much as we can. We need as much reliability as we can. We've seen the impact of Germany reducing their nuclear, and it increases your reliance on the excess, even coal. So you just need to be very, very careful about saying nuclear is not needed because we have renewables. But what renewables? Do you agree with that?
Yeah, I do. I think nuclear is a renewable. Problem comes when you come to decommission it, of course. I think we've got a long history globally of building nuclear reactors on a larger scale. What I like about small modular reactors is that they are more flexible. You can deploy, the idea will be you'll be able to deploy them around the grid, just, wherever you really need to build it relatively quickly. This is about baseload. This is about continuous consumption. So it's not about helping at tea time when prices really ramp up. That's not about switching on. Then we will still need gas or short to medium long-term storage that could be switched on at that time. And there are answers within the renewable sector to that. In terms of expense, what I understand from what I've read, I don't know, and it is a bit hypothetical, this is going to cost about 5 to 7 pence a kilowatt hour. So, today, if I go and fix my electricity price, I'm paying 26p. So it is cheaper from what I've read, theoretically. And I understand, again, theoretically, it is easier to decommission than the larger nuclear reactors. So for my money, it's a good thing. And it's in Wales, so that's supporting Wales and jobs.
I thought you were going to say something else there.
No!
Well, I mean, Hartlepool have got some developments away. They are coming around the United Kingdom, but I think this is the first for Wales.
Yeah,
And
absolutely.
Going up on
Good
Anglesey,
stuff.
I think, and there may well be others too. This is the UK Energy Show. Next, what's being talked about on social media? All right, a couple of things we're going to talk about. ExxonMobil, very much in the focus. Ed Conway, first of all, posted about this. Sky's economics guru, of course. They noting that the Exxon people are closing the plastics factory in Mossmoran, losing some 400 jobs. Well, a person, maybe a man, maybe a woman, called Big Orin, says, hope the government force Exxon to either sell the plant or clean up and demolish it before handing the land back to the local council. Exxon coming in for a bit of grief there, Greg.
Yeah, I think his comment. I understand completely what he's saying. Isn't like, now it's gone. Let's clean it up. Great, but I think I'm actually more interested in what he's commenting on, which is the plastics refinery going down. And I love that this guy was saying, the UK invented polyethylene, and now we no longer manufacture it, no longer export it. That's just an unfortunate reality, which is you lose your competitive advantage. Obviously, the economics don't work. You can't do it. But to be clear, people are going to say, oh, we've lost that to China. Well, we actually haven't. We've lost it to the US. The US export an incredible amount of natural gas liquids and petrochemicals to some extent, and or at least the feedstock for these petrochemicals. So we were taking that in at very cheap rates, and we were processing it like INEOS, that kind of thing, and we're just doing it less and less because we can't do that as efficiently, and global prices and all that. But if we had been sourcing our natural gas liquids more directly, if we've been supporting that industry, and if we'd had better tax situations, you never know. This could still be a burgeoning industry, and clearly we have the expertise.
We've shot ourselves in the foot with this one, do you think?
And it's just yet another sign that that's exactly what we've done. Right. And it is what it is. But you're just going to hear more and more of these stories, and we hear them all the time. But it's just a steady decline, which is almost inevitable now to be dead unless there's a completely big reversal. That's my take.
Yeah, for me, it's a dreadful shame that people are losing their jobs. Hopefully that they can retrain and go into other areas. I think it's really important that, we think about, it's clear that people feel very strongly when things are in their backyard about pollution, environment. But of course, what we need to think here is that with the loss of that revenue, we're losing tax receipts as well, right? So, at a time where affordability, both individually and as a collective, public finances are poor. So, these things all have knock-on impacts that we then need to pay for. So it's not simple, it's not straightforward, and unfortunately it's down to economics.
Comment here from another one about ExxonMobil, actually, because there's a report that they're considering buying some of Lukoil's international assets. This has come from a post on X from Strictly Oil and Gas member. Assets in Kazakhstan and Iraq under review. What do we think of the Lukoil situation is?
Yeah, it's really interesting because this is an oil trader, right? Sometimes people, I think a lot of people aren't aware that they know of the big producers, but they produce it and kind of stand still in a way, right? The oil traders have to come in, take it from them, deliver it around the world to refiners and that kind of thing. So really the oil traders are incredibly important to our ecosystem of oil and gas. So people are very keen to get after Lukoil's assets because they were responsible for delivering a hell of a lot of oil to the world. And something in Iraq, I think, are they talking about the one in Iraq? Yeah, Iraq and Kazakhstan. So Iraq's the big one. And there was talks of Gunvor, which is the Geneva-based oil trader taking over. And then quite amazingly, the US came out and said the gun war is just the puppet of the Kremlin. And, a very controversial statement to make. And I was speaking to people who work there. Yeah. And, 1 minute they were saying, oh, this is great, we're going to get Lukoil's assets, there's more to trade, there's more to do. Next minute, I'm like, well, what does that mean? Like, suddenly hero to zero type thing. And it's pretty amazing that they came out with a statement like that. And it is, we have these rumors all the time about gun war, who are they really owned by, that kind of stuff. But, I don't think there's much evidence of it. But either way, it was remarkable. But it does show you that just because a country produces oil, you got to remember that oil traders are the ones that really do all the work to get the oil. So I think it's an example of how the Trump administration hasn't just generically looked at oil like maybe they've done in the past. They've gone and looked secondary, tertiary, and all the way down the chain to sanction and get more and more of a tighter grip. And that's another example.
This one alludes to, we'll finally do one from a guy called Paul Rainford. It kind of alludes to the COP30 conversation we were having. And it's a familiar argument, this about, why are we doing something when we are a relatively small producer of CO2? And the argument is presented by Paul. He cites this graph. Our world in data is the graph he's alluding to here. And China, of course, produces an awful lot more CO2 than the rest of us put together.
Quite like how he's put it. So glad our bills are very high so we could save the planet, moron. Yeah, I mean, like that is a pretty leading argument, right? Like we are trying to, the narrative is we're trying to lead. So we're saying, look, this is how it should be done and everyone should follow. Unfortunately, another narrative, which if you listen to some of the major podcasts around the world, you hear the Chinese diplomats, they are aggressively saying UK is dead, it's a waste of time. Yeah. So they're not leaders. So then if you're not a leader, then you're just doing it for the moral high ground, which, the UK are known for doing, right? I mean, there's people who will do what's right if they think it's right. And I've always said, and I think that's the point of this show, it's a democracy. If that's what you want to do, that's what you want to do. But you do need to be aware it's having this impact relative to China and it's costing you this much relative to people who are actually making money. If you're still okay with that, that's absolutely fine. But at least you know.
Okay, we're going to be talking a lot about money in the next 7 days or so, because about a week's time from now, we'll be putting together the UK Energy Show just as the Chancellor will be delivering her second budget in the House of Commons. So many rumours and guesses and kites being flown over the last few weeks. Personally, I've never seen anything like it. So, Greg and Julian, I wondered if we could just have a look at some of these things and maybe you could score them as to whether you think the rumours are likely or not. Here's one idea. Let's cut the VAT on domestic fuel, either gas or electric or both. What do you reckon? Likely, unlikely?
VAT, I think it's a possibility, definitely under review. But let's think this is a Labour government and that is a very progressive tax, right? So if I have a large house, a mansion in
I'm going to say thank you, aren't I?
I'm going to say thank you very much indeed. I've just saved myself a much bigger proportion of tax. Yeah. Whereas if I'm a small maisonette with a very low consumption, this 5% in absolute terms is relatively little. So percentage-wise, the same for everyone, but in absolute terms, much bigger impact for larger homes. So I think it's possible. And I think they need to really think how they structure it carefully.
There was an interesting report, wasn't there, from the Joseph Rowntree Foundation, which you sent me on a text message, which I hadn't spotted actually, which is suggesting something a bit different. Don't do that, but actually do some banding where the first bit of electricity, that's quantity you consume, is set at a lower price, maybe with government subsidy to achieve that. So low users or low income households benefit, but then make it progressively more expensive. In fact, your income tax, I suppose, you have bands.
I think absolutely. So you're trying to support that Joseph Rowntree piece that came out yesterday, in fact, that is about weighting the average consumption cost across the market, saying very heavy consumers pay a higher price and they're paying and subsidising, not the government, but those heavy users subsidising the lower, smaller consumers. So you're averaging that price. Again, it needs to be thought through really, and this is where policy is so dangerous. That sounds like a great idea, but what happens if I've already sort of invested in a battery in my home, so I'm consuming a lot at night and not during the day?
Can I cut in? Because that's a really leading point for me, because it's devil's in the details. They said fuel, right? Absolutely. The rumor is fuel.
Absolutely.
We say electricity. I think if you read between the lines, so you've got COP going on, you've got VAT being mentioned to cut, and you've got prices rising, and they probably know prices are going to keep rising with the sanctions. They also know that the carbon border adjustment mechanism is coming in. That is going to make gasoline and diesel more expensive if they import it. Why not cut the VAT? Because they know those things are coming, and they're probably going to get more tax anyway. And the final thing is Rachel Reeves was reported to have reported to the Competitive Markets Authority recently to say we need to see more visibility on the forecourts, and it needs to be a live data set. They want to see a live data set of pump prices around the UK, so that can go to apps like Waze, Google, and then Onyx's app, which you're going to see. Yes. and the point is to increase competition and to try and lower prices
with real-time data.
So I think it's very interesting that she's targeting gasoline and diesel after never not mentioning it at all, and suddenly it's around this time, and it's around the Russian sanction. It's very much about all of a sudden. So I think it is quite likely, and this is completely speculative.
Sorry, but we're confusing two issues here. That's VAT on electricity bills.
I thought the rumor was on fuel.
I'm not sure.
Well, that's what I'm saying.
But actually, what I do know that they're thinking about doing is the duty was reduced during COVID by 5p.
Yeah.
Okay, excise duty on fuel was reduced to 53p, just under 53p. It used to be 59p. That is highly likely not to be renewed, that short-term discount. So I think come April, we'll see duty go up on fuel, on gasoline and diesel. But VAT it may not be immediate because of what does the government also not want interest rates going up?
Well, exactly. I mean, who knows? And while we're just doing one more who knows, vehicle excise duty on electric cars. This seems an inevitability, doesn't it? If you've invested in an EV, you have had the benefit of almost no road charge at all, or smaller ones. The time has come, as I suppose the proportion of drivers changes, nationally speaking, you're going to have to put some tax on them, aren't you?
We don't have a little magic elf with a wand paying everyone, right?
We don't.
So we need to fund that somehow. You can't continue with that process. So absolutely. And I think they changed something earlier this year, didn't they? So you have to pay road tax now. The more expensive the car, if it's over 40 grand, every EV is over 40 grand, I think. Yeah. So that came in, and absolutely you need also above and beyond that, 53p or 59p duty on gasoline and diesel. You can't get that on an EV. So you need a pence per mile fee for how much you drive.
Which opens up the whole road charging by mile debate, doesn't it, really?
Absolutely. So I think we've got, watch this space. We don't know what's coming, but things are going to change.
It's fun to look, though, isn't it, really?
Yes, yes, absolutely.
But I do think it's worth saying that you put it quite well. Whatever they do, they're looking for more money. If they can reduce things and get some political wins that way and still make more money, I think they're going to be inclined to do that. So as you said, if we're going to be cancelling this duty, well, we can also decline VAT.
The problem is the more you tinker, the more you piss everyone off, right?
If they're aware of it. And I guess that's, again, why I'm so happy to do this show, because at least we can say, well, this is actually what happened.
Yeah. And of course, we'll keep you up to date when we get that actual budget detail and drill down into it. Thank you very much indeed. And thank you for watching. Don't forget to click on the subscribe button so you can never miss an edition of this show. And do send any thoughts or feedback on what we've had to say and what we've covered. We'll post those in the comments below. See you next week.
Hello and welcome to the New Look Officials. I am your host, Lisa Aziz, and joining me today in the Flux News studio, I'm delighted to say, as always, our very leading officials, Will Cunliffe, Ed Hayden-Griffith and Spiros Kokos. Hello, guys. Hello. Good to get you back. Well, in this session, you'll get to know all the info you need about the current state of the physical oil and derivatives market. Don't go anywhere. In this episode, we're going to dive into the latest developments in oil markets, uncovering, well, the crazy gas oil moves of the week, why the refining landscape could be about to change, and what to expect in physical benchmarks in the near future. Lots to get stuck into then. Let's crack on. So in the big picture then, what's been happening this week? Give us a rundown.
Yeah, so it's been a little bit more of a exciting week. I mean, just look at the flat price chart here. We've traded in a bit of a wider range. We were touching 65 and then back down to 63. It's been really exciting. I mean, there's been a few different drivers there. I mean, for example, we've had some news come out today about China's import quotas. I mean, we know that China have actually been importing more crude than we previously had expected, given their window activity. So that's obviously been a little bit constructive. We also had some news about peace talks come out between Russia and Ukraine with the US, and that triggered the sell-off yesterday. But I mean, guys, what are you looking at this week?
I think the main thing to look is obviously gas oil, as we mentioned, and we're going to cover later. Products are pretty much rallying. Well, gas oil now is coming back down, gasoline the same, and we should expect as refineries in Europe are coming back into online, that they're going to start producing again. That's really important. Obviously, heading more into Asia side, Algeria refinery is the big thing that we've been trying to figure out recently. What's going on? How many? What's happening with the refinery there, which should come online by the second week of December. So that's the interesting bits right now. More to flat price. It looks, pretty range bound after the news with Russia, especially this today and this afternoon. Has really struggled to keep to try test any direction recently, and the market is just clearly waiting for any news and the sanctions that were, or the additional delay from the sanctions from the Trump administration hasn't made any meaningful progress in terms of flat price action.
So I think as well, when you talk about the Russia-Ukraine situation, as much as wanting headlines, the market wants something concrete. It doesn't want more rumors. We've had so many false starts on the peace talks, on progress being made, and then unwinding the opposite way to more severe sanctions. So I think really the market is going to wait for serious, solid consequences and an outcome rather than more conjecture. So as you say, well, we had this sell-off yesterday. We dropped probably $1 or so.
Absolutely illustrated by that dip there.
But you come straight back up again this morning, and it has no real long-term meaningful impact. And I think
I think it's more of the same sort of. The market is becoming a bit fatigued to it. We saw a similar situation with the Trump tariff announcements. Initially, the market's very reactive, and then over time, the flip-flop, the back and forth. It's no surprise that traders aren't taking directional positions off the back of it when it's just reversed 2 days later.
Well, it can get tedious, can't it? I mean, we've seen it overnight, and in the run-up to the Nvidia results, for example, overnight. Everything drops like a stone, and then it's all bouncing back again.
Exactly, and I think that's exactly the same thing we're seeing in flat price here. We do have that kind of that initial sell-off on the noise, on the rumor, or on the headline, but it's rapidly faded the next day. And that was the same with a similar kind of price action to gas oil, wasn't it?
Give us a sense then of what that gas oil rally looked like, and certainly what caused it.
Yeah, I mean, it was super aggressive. We had like a $4 move in the gas oil crack in a day. We peaked at over $38 a barrel. And, that's monumental. We'd seen that, inventories, they'd been tight for quite a long time, especially in the US and even in the ARA. And then slowly, as we've kind of progressed through the past couple of months, ARA inventories had started to build again. And this had kind of left the market thinking, you know what, like $30 gas oil cracks, that's seeming pretty expensive. So no wonder a lot of traders started getting short. And then we had a cold snap in Europe. You know, we had temperature anomalies like minus 15 degrees in France, degrees Celsius. And that obviously lends support to your middle distillates like gas oil and heating oil. And then obviously the market's super short. So that just means stops get triggered and you have a pretty violent correction to the upside. But then again, today it's been faded somewhat.
Yeah, I think there's also, as well as you mentioned both the stocks and the cold, but I think part of the problem for Europe is that it has stocks, but they're not on the scale that you get in the US. They're relatively small.
Yeah.
So I think the market is concerned that if we have a sustained period of cold, we'll draw on those stocks pretty rapidly. They'll come down and then we'll be in middle of winter, low stocks again, which will make us pretty vulnerable if there is another cold period.
And don't forget that freight is so expensive.
Yeah, well, that's the other thing really, I think, is that the arb opportunity between regions is really limited because of the freight being so expensive. So you can't exploit this higher pricing in Europe than in Asia, for example, because freight's so expensive. If you look at TC14, which is the clean freight route from US Gulf to European continent, it's 16% higher this November than it was last year. So like $5 per metric ton more. So it immediately kind of neutralizes or at least shaves off a large part of that potential arbitrage you can exploit if you are a physical trader. So that's preventing the kind of free flow, and that's part of the broader kind of freight spike really in prices, both in VLCCs, dirty tankers, clean. It's all pretty high. That's factoring also into the dated Brent assessments in terms of CIF versus FOB adjustments. And yeah, I think the freight story is really kind of a hurdle that the gas oil market is struggling to get over.
Well, I wanted to ask, for any, say, new viewers tuning our way, just remind them what happened with freight. What were the drivers of the price going up?
Why?
Well, there's been numerous reasons. We've lost the count with the sanctions packages from the EU. They've sanctioned so many, obviously, Russian vessels. So that's a lot of stress of the vessels that are available in the market right now, which obviously increases the freight rates. So that's one particular thing. And it's just been a constant rally since late August from memory. Nothing has been stabilizing. People have been talking to traders, talking to other sources, even on other products. They've been saying that they expect this freight to normalize and see some products clear into other regions, but this hasn't been so far. So everybody's expecting this to happen at some point, but it remains pretty elevated.
Yeah, and I think if we look at the comparative arbitrage, so if you look at the heat oil gas oil spread, you've had various problems in US refineries, particularly on the West Coast. They're only running at about 70% utilization rates in West Coast refineries, so it's pretty low on a historic basis. They've had several problems with like El Segundo, for example. That was a big refinery that had a major problem about maybe a month ago. And that's led to HOGOs being pretty supported compared to last year particularly. And it's really the freight that's preventing that relationship from normalizing, I think.
Yeah, I mean, just a couple of things to add on the freight as well. We had a pretty monumental rally in fuel oil earlier in the year. So we saw a lot of clean tankerage being converted to dirty tankerage. And the rate at which the fleet is able to add vessels globally is being outstripped by the rate at which Europe is, as you said, sanctioning them. So naturally, we are having a contraction and a decay in viable vessels for arbitrage economics to work its course through. So that means that we're having these pretty big price dislocations, and where we do have vulnerabilities, like at the moment the cold snap in Europe or the low stocks in the US, Asia can't come in to fill that gap in demand. So yeah, we're having pretty violent price action in the product.
So everything you've outlined there, I mean, that presumably is the other things going on in the physical market that's been driving things.
Yeah, and I think one of the key things, or what illustrates the point about the US refining issues, is that we had the first ever cargo of jet fuel, so another distillate fuel being transported from India, from Jamnagar, around to the US West Coast. So the fact that you have only 7% run rates on the US West Coast refineries. Jamnagar sending distillates over to the US West Coast, which has never happened before, demonstrates the problem that you have in the US in terms of particularly distillate refining capacity, but also illustrates that you can't just, you can't replace that refining capacity with imports from Europe because gas oil is so expensive there. The freight route there is expensive. Maybe it's more viable to transport from Asia, but that isn't helping really the overall distillate situation. And I think, like you said, we ended up with this very short market that ended up getting squeezed on Tuesday with that kind of $4 a barrel move on the cracks.
Yeah, I mean, that is quite a striking change in flow, actually. The fact that you've got Kero going into the US from India. I mean, the US is typically long distillate, whereas Europe is long gasoline. Just the nature of the feedstock, the nature of the refinery complex. So typically producing Kero, they don't have an issue with that. So yeah, that's definitely a concern.
Right, let's move on. The rallies supported then margins globally. So what impact do we expect that to have on refining activity?
I mean, right now, obviously we had the maintenance period in many refineries here in the EU. In Europe, so we should expect this to normalize. Obviously, refining margins are very, very high. Obviously, as we saw in Q2 and Q3, many refiners have been doing particularly well because of those margins that remain elevated on a year-on-year and quarter-on-quarter basis. So they've been doing good, and quite frankly, if you're a refinery not running at max capacity, you're mad right now. So. And obviously, any refiners that are coming right now back, which according to traders, pretty much the maintenance season is over, should imply that the run rates should continue to remain elevated in Europe, which more products coming into the market obviously should, in theory, imply a slight downtrend to the refining margins overall, but. It's good to stress that they're very elevated right now, around I think 13-14 per barrel for European refining margins. So they've been very high recently. And pretty much we see elevated activity in Asia, right, Will?
Yeah, so I mean, for a while we've been discussing how run rates in China, specifically in the kind of Shandong independent refiners, have been very low. Kind of down at 48% during kind of the August period. That obviously leaves a huge amount of spare capacity to come online. And for a long time, Asian margins were looking pretty good, and we were like, hang on, why aren't the independents coming online? They could be making good money here. The state refiners, they ramped up, they're up at over 80%. Now they are starting to kick into gear, and we're seeing Shandong independents utilization at about 60% now. So that's up pretty materially from the kind of 48% we were seeing only 8 weeks ago. So it looks like they're starting to turn on, but even still, we have very high freight rates. So absence of freight coming off, it'll take a huge drop in those Eastern product cracks to kind of see that flow over to the West. And I think that will remain pretty constructive of margins in the West, just purely on an arbitrage basis.
Spiros, you made a really good point there. They'd be mad not to be running at max capacity. So why aren't they?
Well, it was obviously maintenance season and unplanned maintenance. So we had the big Kuwaiti refinery, Al Zour, is still down, as we mentioned, which is a very big refinery, it's about 650 KBD. So we're talking about big numbers. And then you obviously have Russia, which has been a consistent target from Ukrainian attacks on a daily or weekly basis. So we estimate around at least 3 to 4 hits on refineries per week. So a lot of refineries have either cut production rates, run rates, or have even gone offline due to unplanned maintenance. And we were even hearing from Russia. Well, they had announced plans that they would extend the subsidies they were giving to refineries, and that implies that refineries, whether run rates remain low or not, that means refineries are struggling domestically there. And it's also a point that's why they also decided to ban exports from refineries and not producers as well of Russia. So that's big news. Russia, from memory, has accounted for about 10 to 13% of the drop in diesel, on the diesel tightness we've seen year to date. So it's definitely big numbers that have impacted the market.
And there's also Dangote, which is kind of a permanent asterisk in the market, because they had some maintenance back in kind of August, September time. Didn't fully fix the problem. They're expected to go into maintenance early January. That's been kind of postponed until late January, but that could see the CDU and RFCC off, so that could help support Western gasoline cracks. But you've already seen, as well as this gas oil move down in the last couple of days after the squeeze, we've seen gasoline begin to roll over as well. So EBOB and RBOB cracks have begun to fall. But as Spiros mentioned, the overall European refinery margins are still at kind of 2-year highs or so, something like that. They're well above their typical level for this time of year. So there is definitely that incentive for refiners to run more and produce more of those valuable products.
Yeah, I completely agree. I do think it'll take time though, because
of course
we are, as you say, ARA inventories are pretty low. We're entering winter. They're going to be drawing on diesel pretty aggressively. And it'll take a while for the inventories to build sufficiently for the product cracks to then come off, I imagine. The same is true for the US. They're basically at the bottom of the barrel in stocks in the US. So we've got quite a lot of accumulation before we start to see, to see product cracks come off, in my opinion.
All right. Well, if we do see, say, an increase in refining activity, is there anything we should be looking out for in terms of the physical benchmarks? I mean, dated Brent, for example.
Yeah, well, dated Brent's been an interesting one lately, because we've had this, as you can see on the chart, this huge drop into the lowest that we've ever assessed since we began back in February this year, assessing dated Brent in the physical differential. So it entered below -$1. We'd never seen that before since we started publication. So this isn't just kind of a typical cyclical move down. This was also partly due to refinery maintenance and also the aggressive window dynamic, where we had Vitol offering loads and loads of cargoes, particularly Midland and also 40s. Starting to come back up again as we come out of maintenance. That kind of bear play seems to have at least played out in the most part, in the most aggressive moments, but they still have a few Midland cargoes that we know of that they could still sell in the window. So exactly. So we're not out of the woods yet, but but there is some upward momentum. And if you do have more European refining capacity coming back online, you could expect some more strength in the physical differential. I think that's in the CFDs. You can see that expectation as well, right?
Yeah, definitely. I mean, according to traders, everybody mentions that fundamental wise and obviously relative to futures performance, the physical market remains pretty weak. Obviously, we're pricing some forward strengthening heading to December. The implied diff is about 50 cents. Yeah. And yesterday our assessed was -45, so we have a long way to go. But CFDs, which are a way to imply dated Brent for next for the weeks ahead, are strengthening right now. So that's good news. That means that markets expect physical demand to keep increasing. So that should imply better physical differential heading towards the end of November.
Yeah, definitely. And I think a key factor was we actually saw one player come out and bid in the window. We saw Mercuria bidding quite aggressively yesterday, and that kind of set the curve higher. And then Vitol ended up getting a bit defensive, didn't they? And ended up hitting.
Well, what we had yesterday, just to go through the window dynamics, was effectively Vitol offered a Midland cargo. Mercuria was bidding the same dates, and Vitol wasn't lowering it particularly fast. That cargo was lifted by another trader, and once that had been cleared out of the way, Mercuria began bidding, raising its bid to above where Vitol had traded with this other player, and then Vitol sold to that cargo. So it does, like you say, look a bit defensive, as though they were kind of, defending where they'd sold previously to make sure things didn't get out of hand and they hadn't sold too low. But whether Mercuria keeps that going, whether other players come in, like we've got some big guns on the sidelines who haven't been involved for a while that could easily
what's happened to them?
Could easily step in. Totso, Gunvor, etc. They've been pretty quiet lately, so there is certainly firepower on the on the sidelines.
Moments like that, though, when you're on the desk and moments like that happen, is that quite exciting?
Yeah, when you see you're looking at the trades and you're thinking, okay, that implies that the diff will be down to minus 50 cents, and it goes down to minus 70, then the next day it's down to minus $1. It's like we've never, as I said, we've never seen that before. So when you're calculating it, when you're looking at it, it is pretty like a first time experience. So yeah, definitely an exciting one.
Yeah, can be a bit destabilizing.
yeah, definitely. But over in Dubai, the things are not like that. I mean, unfortunately, we haven't seen any interesting momentum driving the physical premium. We've seen a couple of elevated here and then activities in terms of volumes. Like we had 80 trades, 78 trades from 70 trades. I saw spectacular compared to last month. Last month we were like, oh, we'll come here. We had 200 trades or something.
Yeah.
So it's not the same, and the physical premium remains very tight and rates bound around the 70-cent range, which has brought our physical premium for the month. Just over $1 right now. It's 25
I mean,
cents.
it's a remarkably stable window dynamic. To be honest, you have Tots and Trafi on the buy side, China on the sell side, and that's been the same all month really. We're seeing that kind of physical premium drift down a little bit, down towards 70 cents a barrel, and the average so far for the month, as you can see, has been just over $1. So that's knocking about 25 cents off versus the average last month. So I mean, expectations for OSPs, I think they're probably going to have to cut again.
Yeah, definitely. They've been very lenient on the previous cuts. Obviously, the market was pricing, especially on for the October's monthly average structure. The market was implying them to cut by more, which they didn't. So I think 20 cents has to be at least if things keep going like this. Obviously, it's been a very quiet month, and again, it depends on the final week average, which has been a key tool for them when they assess the OSPs, right?
But if we continue in our kind of sideways trajectory, we'd be looking at a final week average in the 70 cents range. So that'd be even weaker. Also, it's worth noting that the first day here, I think, was over $3. So that is skewing massively the average, despite the rest of the days being like 120 or below. Most have been under $1. So whether they have to disregard that one day as an anomaly, I mean, you got a pretty choppy end of month and beginning of this month, so they might well just disregard that one and see what else the arithmetic comes to.
But then again, they set OSPs a little bit firmer than structures implied last month. The allocations to China are a little bit softer than we expected, but we're hearing that India was picking up more, Japan was picking up more, and so was South Korea. So they're finding demand in Asia. Perhaps that they see that demand and they continue to set a little bit firmer than structures imply, and we might end up with a cut more like 10 cents or even flat. Who knows? It seems pretty difficult to read Saudi's minds at the moment.
Yeah, you can never, once you think you've tried it, we've unlocked the door. there's another lock somewhere. So has been very, very hard to identify.
We'll hold you to that, see what happens next week. Because that is it for this session of The Officials. Remember, though, for a deeper dive into our research and data offerings, you can just visit flux.live, and feel free, of course, to reach out to us with any questions and comments. So thanks, guys, and see you all next week.
Hello and welcome to the official Singapore window. Now, today what we had in Dubai was a small bounce on the physical premium. So we jumped back up to 63 cents, having been at 49 on Friday. Now, this is important because this week is one to really pay attention to with regard to the Saudi OSPs that will be coming out towards probably the end of next week for the next month, because they have previously used the final week average to set their OSPs. But that does imply that unless we see a significant strengthening this week, there would be a weaker than expected OSP. So that's one to watch. Already on the monthly average, we're 30 cents lower this month so far than we were last month. So in any case, looks like that we're going to get a cut. But in the window itself, what we had was really more of the same in terms of who's doing what. We have still Trafi and Totsa as the main buyers. Got 3 more convergence today, including the first Oman, which was declared by Vitol to Totsa. And really, those two have dominated, as you can see from this list. They've dominated the buy side. We have got Glencore becoming a bit more active at the moment today. Also, Hengli, which had been selling. You can see that they declared a convergence here to Trafi last week. They flipped to the buy side late last week, but now today they've gone back to selling again. So that's an interesting one to watch, because we've seen really this kind of variety of Chinese players. You know, you've got your Unipec, Sinochem, Hengli, etc. They've all been on the sell side. So Hengli's behavior has been pretty interesting. But yeah, we've got to 25 convergences there so far this month. So it's really been quite consistent, really. It's been quite a steady state window this month so far. And now that also kind of feeds into flat price, which, you know, this month has been pretty range bound. Throughout November, we've been kind of stuck in this $65 to $62 range. Except for a couple of, as we can see here, except for a couple of little dip peaks above 65, which you have like here and here, but they haven't lasted long. We're really stuck between the 62 level here and the 65 level up here, and it's been pretty kind of sideways throughout most of the month. But one thing to keep an eye on is really this futures spread, this prompt futures spread for Brent, because we've got to over 60 cents again, and that is extremely strong given the physical structures are pretty weak in both Dubai and Data Brent. Remember, Data Brent physical differential is still negative, even though it's been strengthening significantly over the last week. So this futures strength is really kind of disproportionate to the physical spot market. Likewise, Dubai, you know, this is the Balmo M1 Dubai swap spread. 20 cents relative to Brent is very, very weak. So that divergence between the two crude benchmarks is really continuing. And I think really what we're looking at the moment is the Russia-Ukraine negotiations. And I think flat price is going to wait until we see some kind of solid development there, something concrete, before it can make some kind of really violent correction, either upside or downside. Downside may look more likely, though, if we get towards a peace agreement. So stay tuned, and we'll bring you those news as we get it.
Hi everyone, I'm Stuart Mitchell and I'm a Senior Energy Analyst here at Onyx Commodities. I'm delighted to welcome you to this immersive course on the European gas market. The European gas market has changed more in the past 3 years than in the previous 3 decades. From the collapse of Russian pipeline supplies to the explosive rise of LNG, the story of Europe's gas is one of transformation, volatility, and resilience. In our Explainer series on the European gas market, we break down everything you need to know, from demand, supply, and storage, to how gas prices are formed and why they move. You'll learn how weather drives heating demand, how gas competes with renewables in power generation, why storage levels matter, and how Europe rebuilt its energy security in record time. Whether you're an analyst, trader, policymaker, or just energy curious, this series gives you the insight to understand what's really powering Europe today. Watch the full Explainer series on the European gas market and see how the continent's energy system is being rewritten in real time.
Hello, and a very warm welcome to the New Look Macro Mondays. I'm Lisa Aziz, your host, and with me in the studio today are James Brodie and James Todd. Morning, guys.
Morning.
Morning, Lisa.
Good to see you. Just to actually remind our viewers, if you would, a little bit more about what you do and which areas you cover in oils and derivatives.
Thank you. I'm a former trader and now I'm head of learning and development here at Onyx Capital Group.
Brilliant.
And I was on the trading floor at Onyx Commodities and now I'm trader performance manager.
Brilliant. What, though, is exactly Macro Mondays? Well, each week we aim to cut through the noise to bring you the key global macro stories, the trends, charts, risks and trades that matter most. So in the next 30 minutes or so, we're going to be taking a deeper dive into those volatile US equities. Why did those really good Nvidia earnings end up rattling the markets? Also, weaker UK data. What does that all mean with the budget looming, of course, this Wednesday? Plus, we'll be asking, why are the crypto markets collapsing? And do stay tuned naturally right until the end, when we'll be sharing details with you of our brand new training courses available online and at our London offices alongside our new traders. Right now, though, let's get stuck in. Lots to cover off. Those weakening US economic stats, then, we've seen emerge in recent days. James B., how would you sum up the picture?
As you say, the economic data is weakening. We had September payrolls came out last week. Of course, because of the government shutdown, that's massively old data. Actually, the headline number came out higher than expected, beat the market, but again, old data. Key concerning point, though, is the unemployment rate ticked up, as you can see from the chart here. And actually, you go through economic cycles, you can see it's a weakening economic cycle in the US. Also, more timely data we had last week, the weekly jobless claims, that came out higher than expected. Again, that's bad news. 232,000 jobs were lost last week, expected to be 223. So that's...
Yeah, I mean, I think as well, one of the things to emphasize is ultimately a lot of this data, it was retroactive and not high quality data. But I think this unemployment figure is something that people are really looking towards. And whilst the September figures are slightly unclear, people are looking forward to the October and November data and not looking upon this favorably, worrying that unemployment is going to be higher. And of course, that's going to have to be impacted and be met with government response.
Well, indeed. Now, of course, it will rattle Trump, won't it, in his administration, trying to deliver a completely different narrative to the US citizen, i.e. that they're going to deliver better days ahead for them.
Yeah, but the big problem for the Fed is the data comes out after the next Fed meeting. So the Fed are meeting on the 10th of December, but the data comes out the following week. And if I move on to the next chart, you can see what's concerning for the Fed. Well, unemployment's going up, inflation's going up as well. So unemployment going up, the market says they should cut. Inflation going up, of course, they need to be on hold or even hiking rates. So CPI was at 2.2 in April. It's now at 3%, being driven by the tariffs, but it's clearly moving in the wrong direction.
A bit closer to home then, UK data, of course, we've seen that weaken, haven't we, ahead of what is clearly a huge week for the Chancellor and her budget statement on Wednesday.
One chart quickly before that, though, is we look at US consumer confidence from the University of Michigan. I mean, this chart's going back to...
Actually, no, I've messed that up. What I tend to put at the end of the question is how many charts are coming. So that's by fault.
But if we stick with the chart here, University of Michigan consumer confidence, you can see we're going back all the way to 1990. It's only been lower during the peak of inflation in June 22. The US consumer's hurting badly. Unemployment's going up, inflation's going up. So Trump's, his ratings getting hit pretty badly here.
They absolutely are, yeah.
And my big concern is as AI comes in, certain jobs, low-income jobs are being replaced as well. So Trump, he needs a quick win, and I think he's turning to Ukraine for that.
Yeah, the narrative is very much that, if you look at headlines about sort of Amazon cutting jobs, etc., AI is supposedly the leading cause of this. And that's not even necessarily because of AI being used to replace bureaucratic jobs, but it's also the amount of money that is having to be spent on AI by companies like Microsoft. So Amazon Web Services was basically, that was their high margin part of the business, and sort of retail shopping and shipping was low margin. To see their expenditure rally on such high prices for chips and AI software has meant that they're having to cut jobs. So I think a lot of people looking at this is really, really worrying that not only are we going to see unemployment probably rise in the future as bureaucratic jobs are replaced by automation, but also the expense on this automation is going to be increasing. So it's very worrying for sure for investors and also for consumers.
I agree with you on the investment costs for these tech companies, but other companies actually earnings are going up because actually they've got a lot of costs being reduced. So I think that's one of the reasons why we're seeing the S&P 500 is holding up, whereas you're seeing the AI stocks are being hit lower.
Right, let's now tackle some of that UK data a bit closer to home.
Yeah, if we move on to the UK, we've pretty poor data last week. Retail sales expected to be flat month on month, fell 1.1%. Expected year on year to be up 1.5%, came in just up 0.2%. So consumer here's not spending either. UK government current budget deficit also is tracking to be 15 billion more than projected. And also we had some flash PMIs last week. You can see from the chart here, and the employment component is falling, which you see correlates very highly, of course, with payroll employment. So UK data is pretty weak, and we have the budget looming this week.
Yeah, absolutely. I don't think it's catching anyone particularly by surprise, though, as well. This any surprises in the data would have been to the upside, and particularly as you're coming in towards, what is a strong season for retail typically in terms of consumption. To see declining data, it's emblematic of wider problems in the UK.
How do you think the sentiment will be inside number 11?
Going to be pretty worrying. The Chancellor's deliberately pushed the budget back to the end of the year to try and hope the economy will be in a better place. It's not, it's in a worse place. They've thrown so many possible implications of what they may do. It sort of covers to mask, what may have come out, but I think it's going to be pretty concerning what comes out on Wednesday.
Markets must be on tenterhooks, right?
Absolutely. And when you're seeing, obviously there's going to be a large impact on the gilt market first and foremost. We'll also come to talk about cable, but ultimately Reeves is going to be in a very tough position. She's going to be stuck between a rock and a hard place. And, to my mind, it's essentially an impossible decision. The tools available to her are very blunt. I think, as you say, she was probably hoping for an uptick that was, out of her control, and she could point to things and not have to be severe. But it looks as though she's going to have to be quite drastic. And that's going to be worrying for the gilt market, worrying for the UK economy, and also worrying for her, position at number 11 ultimately.
Oh, quite.
But we need something fairly draconian, as we've seen in Argentina or in Italy, but the Labour Party don't want to cut the welfare state, and it looks like that may even grow this Wednesday. And we've seen now companies saying they don't want to invest in the UK. Over the weekend, we've seen another Lakshmi Mittal, the 7th richest man in the country, has decided to leave because of tax.
That's an interesting move, because of tax.
Yep. So it's not good. And if we look at the charts, cable, if we bring that up, so this is the pound against the US dollar, you can see the pound is going down. It's sort of, there's a key support line. It's 131.85. It broke below there. What was the support comes resistance, and now it's starting to fall again. So again, This is the pound, one of the weaker G10 currencies. Only the yen is weaker at the moment. But again, there'll be a big focus on the budget. And again, will it be another Liz Truss moment?
I would expect this trend over the longer run as well to be significantly down. Not just talking about for the next sort of 3 to 6 months, but longer than that. And if you look at the number of companies IPOing on the London Stock Exchange, we are at pretty much all-time lows, lows for the modern economic period, ultimately, since about 1990. That reflects investor sentiment and business sentiment in the UK being very, very weak.
Right, let's hop back across the pond, go back to the States. Just take us through, if you would, the volatility that's faced US equities of late and the key drivers.
Yeah, we had a big week this week with the Nvidia earnings. So that came out, that beat expectations. We'll come out with the Nvidia chart in a second. But we saw an aggressive sell-off that day. Actually, the earnings came out overnight. The following day, the market opened significantly higher and then ended up closing lower. So we saw S&P, there's a key support level here at 6,550. The market closed kind of right on that on Friday. Well, actually, it bounced on Friday because the market's now expecting a Fed cut. But it's an absolute key level. If the market closes below there, we'll see stops triggered and we'll have seen a top of the cycle in S&P. So the market's hoping for the Fed to cut. And if we move on to the Nvidia chart, see, Nvidia earnings came out, revenue 57 billion, that's up 22% quarter on quarter.
Just explain that to us, because it surpassed expectations.
Absolutely.
So
but
everything went up but straight down again.
Yeah, the market on Nvidia opened, you can see here, opened up 6%, but then immediately got sold into. So there's concerns around the AI, the amount of debt that's being taken. And the market opened, to say, up 6%, finished down 3%. There's a key support here. Right on it, $180. Again, if we close below that, we'll see more stops get triggered. We'll see more selling. Again, there's huge leverage positions in these AI stocks.
My take on this is that this is a really significant moment. Ultimately, we saw a mass liquidation event across multiple asset classes on no significant headlines, if anything, or no bearish headlines.
On good news, yeah.
Exactly. And so to see such a liquidation event, I think you can really infer a lot from this. And the inference is that this is the likelihood, the balanced probability is that this is a bubble and I want to take profit on this before the bubble bursts, ultimately. That's what I think a lot of investors are saying, a lot of traders are saying. I think we could be at the top of a really sharp decline here.
Yeah, and if the market can't go up on good news, then it's going to take something pretty substantial to get new all-time highs.
For sure. Just remind us then to... Oh, no, you want to take us to the Oracle chart?
Again,
let's go through this.
We discussed this last week. Yeah. This is Oracle. This is a credit default swap. So back in, I think it's September, Oracle briefly had the biggest market cap of any company in the world, based on their build out into these AI, the power, the data centers. But you can see the market suddenly getting pretty nervous. Oracle's fallen over 40%, I believe. Credit default swaps are going up. So the market's saying, yeah, is there a chance they actually default on their debt? But here you can see it's overlaid with the investment grade credit spread. So this is the difference between the investment grade credit, the bonds, the bond yields of the top companies, the spread between that and US government debt, which is seen as risk-free debt. And you can see those spreads aren't widening out yet. So the market's kind of saying this volatility is specific to AI. And in fact, if you look at the interesting point with it as well, a lot of the debt potentially for these AI stocks is actually going to come from the likes of Microsoft and Apple, who are AAA rated. So that may be a saving grace, but just the huge amounts of debt being talked about, that's why we're getting these concerns in the market. Also, fund managers. So Bank of America Global Fund Manager Survey. Here, for the first time ever, the record number of investors say companies are overspending. So again, this overspending and concern about debt, it's gone positive for the first time ever, and that's all based around AI.
Yeah, I would flag that on this overinvesting issue. Ultimately, there will be a political side to the answers of a lot of these fund managers as well. Because if you are investing in something that your country doesn't have a comparative advantage in, you would look to that and say, that's probably a misallocation of resources. That's over investing. And ultimately, though, it really is a comment on how much debt a lot of these private companies are accumulating, and people saying, this is perhaps coming towards like a bit of a terminal rate.
There was also a lot of chatter here, when the Nvidia earnings came out, and talking about, the ambition is for so many big data centers, so many hubs. I think there's going to be a couple announced just this week in Wales, for example. But there's a lot of chatter about, where are we going to get all the power to power these massive sites? Because apparently at the moment it's single digit, level of being able to power these centers, the energy that will be needed.
Absolutely. We mentioned this last week. Nvidia in its hometown has built 2 data centers, and they're not running at the moment because they don't have the power to run them. So the question has moved on, not so much to AI, but what's going to power AI.
It's also getting more power isn't an overnight issue. You can't just, magic it out of nowhere. So it takes a lot of investment going forward. Whether people do invest ultimately depends on whether they see the power demand from data centers as being a reliable long-term demand pool. Because if it turns out that all AI is a bubble, there's going to be no demand for it in 5 years' time, and you are a significant power generator in the UK, and you've suddenly invested a huge amount for what could ultimately be lackluster demand in 5 years, you're not going to have a very happy board of directors to answer to. So.
And China's a country that's on top of this. China every 18 months adds more power than the US has in total. If this becomes an arms race, who can come up with the best AI, then that's a comparative advantage that China definitely has.
Meanwhile, everybody's terrified they're going to lose their jobs through AI, but not necessarily overnight by the sounds of it.
No, and ultimately, a lot of these people have a huge amount of uncertainty, and people on social media are quite easy to whip up into a hysteria these days. So I would say keep calm and carry on for now.
Love it.
And again, the S&P chart that we looked at, the S&P, despite all this volatility last week, is just over 5% off its all-time high. So
in the great scheme of things.
And in the great scheme of things, it's not a particularly big move. But one other chart that's interesting is this one. Private equity stocks are rolling over here. So this is the S&P listed private equity index. And of course, these are sort of leaders, forefronts in company development. But you can see here, tight correlation with the S&P 500. And clearly, they're currently moving in opposite directions.
Let's move on. Just remind us, we've touched on it earlier, but the latest sentiment, say, surrounding any possible rate cut decision by the US Fed, as you said, James, 10th of December.
Yep, Friday morning, as we said, equities looked like they were going to break aggressively lower, but suddenly bounced when we had more dovish Fed speak. And now the market's pricing from 30% to 77% chance that the Fed cut on December 10th. So the market's now expecting a cut, which supports equity market. If you look here again, this is the 2-year yield. You can see there's a clear support there around the 340 level, clear resistance above. The OIS is pricing 88 cuts in the US over the next 12 months. So the market's saying the Fed are going to keep cutting. And what we'd need for that to break lower actually would be weak payrolls. Even if the Fed come out dovishly and they do cut, there's already 88 basis points of cuts priced. But that will be the payrolls that come out later in December, just after the Fed meeting. If that's really weak, then the market will start to panic. Yields will break lower and the market will price more aggressive cuts.
On to currencies. How are those markets looking?
Yep, we discussed the pound as weakening against the dollar. Moving on the dollar chart, you can see the dollar index here. And 6 months ago, it's all about dollar weakness. But I think it's part of its US exceptionalism. The economy is resilient. We have these tech companies. Earnings are still strong and the dollar's bouncing. So this is the trade weighted index, dollar index, which is 55% of that is a dollar against the euro. But the dollar's clearly bouncing. There's a key level here you can see at exactly 100. And markets like technical levels, round numbers, but you can see a break above that. And then the dollar strength will continue. Particularly strong against the yen at the moment. Of course, the yen has their debt concerns. But clearly it's strengthening against the pound, it's strengthening against other currencies like the euro, Aussie, Kiwi. New Zealand's expected to cut this week, but we're seeing dollar strength.
Brilliant. What about commodities? Similar picture there or not?
Yep, And if we look at gold, favorite chart at the moment, or favorite commodity, I should say, of the markets, you see we had this huge rally, sort of 4-month rally, pulled back, bounced again. You can see we're sitting on a key support line here.
My take on gold is that ultimately the liquidation event that we saw last week on the post Nvidia earnings, this managed to affect a huge number of asset classes, and the fact that it didn't affect gold that much is, for me, that's a telltale sign that gold is supported here. So I would be surprised if we were to break down below that sort of $4,000 per ounce level. It's probably going to be a bit of a range bound asset class for now. I would be surprised if it were to break above 4,400 without significant news or something ultimately changing in the wider ecosystem that meant that gold was, incredibly sought after. If you were to see, worrying signs, perhaps if the dollar were to break lower, that might be your impetus to see a breakout to the upside, but that would only happen if we were loitering around the sort of key support, the key ceiling. But yeah, so I think the fact that gold has maintained some momentum here is a bullish sign ultimately.
Yeah, I think an interesting point with gold as well is Thursday, Friday, when equities got hit hard, you'd expect it to bounce, but it didn't. I think part of that is because hedge funds were liquidating positions across the board. So they'd be unwinding, they're unwinding potential losses in equities, they're unwinding profits elsewhere. But I agree, over time, I'd expect gold to continue going higher. We've mentioned for months now, we have the central banks rotating into gold as well. So we definitely know there's a bid under that market. If we look at uranium, despite the long-term needs for uranium for power demand, you can see that's falling aggressively. I think this just ties in with the whole AI and power story. There's concerns there around the AI stocks.
I would have thought you'd see a good correlation between uranium demand and ultimately price action and AI stocks overall, probably for the next 18 months or so, as uranium is probably one of the fastest growing power supplies going forward.
Absolutely. And the one commodity that held up actually last week was copper. So that's onto the next chart. Copper, you can see here, it's going sideways. Well, the others have been hit. Uranium has been hit hard. Gold's had lots of volatility. So I think, again, we know copper, there's a long-term supply shortage.
So we spoke last week, didn't we, about actual grades of copper. People were concerned about the quality that they could get their hands on.
And also the amount that there is in supply and how long it takes to get these mines on board. You can see if copper's not selling off while other commodities are, then again, that means there's an underlying relative strength in there.
Right, should we talk about that crypto crash still
Brent,
ongoing?
actually, let's go to Brent. Let's look at Brent. We have a chart here, correlation with the 10-year yield.
Yeah, I mean, the sort of headline in Brent is ultimately nothing that much fundamentally seems to have changed. We still see, margins being very high for refined products, which should be providing support for the outright Brent price. But we saw that liquidation event last week, Wednesday, Thursday, being passed through into Brent as well, and we saw flat price come off about $2 a barrel. So yeah, it's not hugely supported, and ultimately it is an asset class that managed money does still speculate on. So that's the story with Brent as far as I'm concerned.
Do you think the news this week on Russia-Ukraine will impact Brent?
I mean, if we were to see a ceasefire and everything sort of renege and have ultimately Russian barrels coming back onto the market with no sanctions, then that would undeniably act as, a dramatic increase in legitimate supply in the Brent pool. / also you would see legitimate demand for Urals, which would pull demand away from implied Brent. So that would be very dramatic in terms of price action to the downside, which also suits Trump's sort of drill baby drill, low oil price narrative. So yeah, if we see a reconciliation on that side, then yes, Brent should come off. I would be skeptical. I wouldn't assume that Ukraine are going to automatically accept this round of Trump-led peace talks. It seems to be very, it seems to be very favourable to the US, these peace talks.
And to Russia, I've seen one US senator call it a Russian wish list.
Yeah, quite. I think it's all hinging on the next 24, 48 hours. But we do appear, though, the overview is we appear to be close to something which has taken an awful long time to get to this point.
And
But
Trump's
clearly,
trying to force it through, though, isn't he?
well, yeah, and presumably the chatter is that, you know, he's done deals behind the scenes as well on things like rare earths and whatnot, which is, you know.
And I'd be
wants to
cynical
tie
to
that
say
up.
it's exactly to help his ratings, which are currently pretty low.
Not too
and
good,
falling.
as you took us through at the start of the show. Crypto crash then, let's go back to that.
Yep, crypto, you know, it's down 24% in November already. You know, it's the worst month since June 2022, third worst month this decade. You know, people say it's a store of value. Well, it's down 24%. Ethereum's down well over 34%. You know, gold's only down 7.5%. Macro strategy, important one as well, worth mentioning, that's down 68%. But certainly Bitcoin is not a store of strategy.
Yeah, I think crypto got hit across the board, but particularly if you look at the headline standard, obviously Bitcoin, it took a hammering and broke through this supposed $88,888 lucky double eights in Asian cultures quite often. It broke through that key support very fast. So that really didn't provide that much of a bounce. And yeah, you know, seeing the correlation between a lot of the NVIDIA style AI stocks, there has been a historic correlation between those. So it's the momentum, the wind is out of Bitcoin sales in that regard.
Yeah, from the chart, I see the next support at $77,000. But an interesting topic I'm seeing discussed now is that the market, the crypto market, should not focus on Bitcoin as the market leader anymore because it uses so much power. And of course, the need for power is now much more focused on AI stocks, whereas you don't have the same proof of work power demand for cryptos like Ethereum.
Now, we touched on possible movement, didn't we, a little earlier on by the US Central Bank. What about those thoughts on others cutting rates?
Yeah, we have the New Zealand Central Bank this week looking, the market's fully priced in 25 basis point cut there. The market's also looking for 25 from the Bank of England in December. But actually across the board, other than that, the market's basically saying we've seen the bottom in the cycle. Yeah, ECB, there's not a full, not even half a cut priced. After this cut in New Zealand, their RBA Canada, the market's saying that's pretty much the last cut of the cycle. Personally, I think you'll see more cuts because if the US economy slows down, that will impact the global economy. So I'd expect to see more cuts. I've mentioned before, inflation's a problem in the US, but in Europe, you're more likely to see disinflation and perhaps even deflation as China offloads its goods. So I'd expect to see more cuts priced in the Eurozone, which would push euro dollar down as well.
Right, let's take a look now. What key data and events are happening this week? What should we all be looking out for?
Yes, certainly. Data this week. Well, we've had German IFO already out today. Tuesday, we have US PPI and retail sales and ADP employment. On Wednesday, we have the big UK budget, US jobless claims, PCE inflation, which is the Fed's favoured inflation data, new home sales and Australian inflation. Thursday is a US holiday, Thanksgiving, and then Friday, Japanese CPI, employment and retail sales data. So it's going to be a quiet end of the week with the US out, but certainly plenty to keep an eye on.
But I think we'll all be having a lie down, quite frankly. Just before we go to James B, just remind everyone where they can go to get plenty more information about your fantastic courses.
Yep, as we mentioned before, we do internal training here that people can join, external candidates can join when our new traders join. We do external face-to-face training with our clients, courses, everything from commodities, financial markets, derivative trading, risk management. Chris Gooder, our Formula One head of performance psychologist, he's doing training on psychology of sales, peak performance, technical analysis, behavioral finance courses accredited by the Institute of Banking and Finance in Singapore. So we do these face-to-face with our clients. We also have some online training. So you can find that with this QR code. It'll take you to our website.
What a brilliant offer. Fancy a refresher then, James T?
Yeah, definitely.
All right. And that is it for this week's Macro Mondays. Huge thanks, of course, to James Brody and James Todd, and to you for watching. Remember, you can get lots more about what we do over at Flux.live and Freemium. See you next week.
If you look at sport, for instance, the top tennis players in the world, the top all sports, they still have a coach at the very top level. And you have to keep improving and keep learning. And I'm still learning stuff, having been doing this for nearly 30 years. So that's why it's so important to just keep learning, whether it's technical analysis, behavioural finance, what's moving the market is changing every week, whether it's economics, fundamentals.
Welcome to our first episode of Inside the Mines. I'm Chris, Head of Client Management here at Onyx Markets, our brand new retail trading arm to Onyx. And I am joined here today for our very first episode. I'm very excited, Mr. James Brodie, who you might recognize from previous videos such as Macro Mondays and the various trade ideas and oil insights. So James, welcome.
Thank you, it's good to be here.
So we're just gonna, have a little bit of a chat. Want to know everything about, your previous history, how you got started, and any tips and tricks you can give to our retail clients and anyone else that's, watching. So, I mean, what initially sparked your interest, in trading, and how did it all start?
It started, to be honest, back when I was at school, and my grandfather was a very active equity trader. And so I used my savings. I bought some shares in Tusker Resources. And then when British Gas privatised, I bought some shares in that. And to be honest, it was easy to start with. Share prices just went up until 1987, the crash. And that's when I learned about risk management, or lack of risk management.
Okay. So would you say that when you first started, you had risk management, or you didn't have any risk management?
I didn't have risk management
Nothing at all?
Everything just went up. It was too easy.
Wow. Okay. And then what do you think the biggest challenge was when you first started? So before you kind of went into your professional career, what was the biggest challenge that you faced early on?
Well, the biggest challenge really is learning about the products, risk management, even behavioural finance is absolute key. And I didn't learn that till, I've been trading for about 15 years. And then you look back, I remember reading a book on behavioural investing by James Montier, and I laughed and I cried as I read it because every single bias I could relate to myself.
Yeah.
And I've been trading for at least 15 years at this point.
Yeah. I mean, I know that, previously when we've spoken, when I first came to Onyx, and, some of the stuff that, you've done, in your institutional days at, the banks, is still stuff that you carry on today, even though you trade for yourself sometimes. So I want to dive into that a little bit later. But when you did start, was there anyone during your early days in your career where you had like a mentor? Did someone take you under their wing and kind of show you the ropes?
It's interesting actually. When I started trading, it was originally actually at Daiichi Kangyo Bank, and I'd been there literally half an hour. I'd been introduced to my manager, Keith Broughton, at 9:30 in the morning, and the head of the dealing room came up, Japanese head of the dealing room, and he bowed and he passed me a piece of paper and he said, "James son," which is polite Japanese introduction. He said, "Here are your derivative trading limits." And I turned to Keith and I said, "What's a derivative?" And quite literally, I was given trading limits. I'd been there. They were chunky limits as well. I'd been there half an hour. And he laughed and he said, "I think you better read this book." And he passed me John J. Murphy's Introduction to Technical Analysis.
Yep.
And that's really what kicked me off with, I'd say, disciplined trading, but that's probably the best thing he could have done, because otherwise you join a trading desk in those days and you're just sitting there entering other people's trades. You're not getting any formal training at all. In fact, in my banking career, which was nearly 20 years, I didn't get a single day's training. It was all...
Not once?
Not once off the desk. So it was all on the desk, asking questions, or you just read for yourself.
Wow. So there's your limits. Read this book and off you go.
Absolutely.
Wow. And then would you, to go back there, would you change anything about that? Would you do the same to someone else? Because I know you train in-house, traders here. I know you've trained myself and my team as well. And, we're looking to, give that to the retail markets as well. Sorry, the retail participants with Onyx Markets. So, I mean, you have developed your educational services quite a bit from that. I didn't get a massive book to read and some limits.
No, it's absolutely the worst thing to do, because some people will sink and some will swim. But what we do here at Onyx now, as you say, the new traders, we give them classroom training before they go on the desk. Everything from introduction to the markets, we go into all the commodity markets, equity markets, FX, bonds, emerging markets. We talk about the correlations, and we talk about derivatives and pricing. Then technical analysis, behavioral finance, fundamental analysis. We look at charts each day, every day. Looking at what's moving, why they're moving, and of course we are head of performance. We bring in Chris Gooder.
Yep.
He talks about the behavioural side as well, peak performance. So we really give everyone a really good solid grounding before they go on the desk, and even on the desk, then they're learning from the traders around them.
Yeah,
but it's absolutely critical to learn about risk management.
100%. So would you say risk management is up there with your top 3 tips? I mean, we'll get onto that later, but your top 3 tips, risk management has to be up there, right? Especially if you're first getting started, even if you're a seasoned professional, you have to use risk management.
It's all about managing the losses.
Okay, yeah. So then in terms of, your trading style, from your first day trading and then, getting those limits, and then let's say, 5 to 10 years later, how has that evolved over the years to, what you do now, and, how you trade now?
Interestingly, it's gone full circle. So what I did when I started at DKB, was I read the book literally within a month. I read it and I focused then on trend following. And what we had a year and a half later, we had the bond crash in '94. I'm showing my age here. And desk of 11, there were some fairly catastrophic losses on the desk, but I was still in a profit. nice profit, healthy profit. And my trading had been consistent. And that's when I was approached by Credit Suisse. And what I found at Credit Suisse, as I took more risk and I made more money, then all the biases started to develop, particularly overconfidence, too big a position. And that's when the profits got bigger as well, but the losses became
even bigger.
Yeah, exactly. So that's when I learned the importance of, well, two things really. That was risk management. But then when I started to read about behavioral finance, understanding the overconfidence, position sizing, loss aversion, instant gratification, fear of missing out, and there's like over 140 biases. There's like 28 key biases, but we all suffer from them, and that's as important as the risk management and the technical analysis. So what I've done, evolved to back now, is back to the simple trend following. So you have a fundamental view, and then you only put the trade on when the technicals are set up.
So that's very interesting. I mean, speaking to, retail clients for, almost a decade now. And one thing that always comes up is, well, banks don't use technical analysis. Goldman, Credit Suisse, they don't use technicals at all. It's all fundamental driven. But you did use technicals when you was on the desk.
Absolutely, and they still do. They all do. If you look around our trading floor, you walk around, none of the traders will say they're technical analysts, but they've all got charts up.
Yeah.
I remember the prop desk at Credit Suisse, which later went on to set up to become Brevin Howard, one of the biggest hedge funds in the world. And they all have charts up. None of them will say they're technical analysts, but they'll use that for their entries and exits and
good. I mean, we spoke about this before, and as good of an idea it is to, right, the macros are looking bullish, I think the market's going to go up. Instead of just, going dartboard, get me in. You do need the technicals there to show you could be at a key resistance level where the price won't budge above that. And if you're trying to buy running into a brick wall, the wall might not go through. So, it is definitely important to take into consideration.
Exactly. And if you have a fundamental view on the economy, so you might want to put a bond position on or an FX position, or you have a view on an equity, you think it's a really good equity, well, you wait till the price is moving up. So many people will buy it when it's coming down thinking it's cheaper, but it's not. It's trending and it's going against you.
And we always talk about, wait for the market to come to you, put your key levels on there. Don't chase the market. Wait for it to come to you, favorable level where you want to do business at. And, going off of that, I'm eager to pick your brain on, do you have a specific checklist that you kind of these 3 criteria or 4 criteria or however many, before you enter a trade, you need, right, I need that to happen, I need this to happen, and I need this to happen. Once all 3 are in there, I've got my, confluence, and then I can, happily enter the trade.
Well, it's interesting going back to what you just mentioned. Instant gratification is a big issue for traders. For retail, because they want to make the instant profits. But also it's quite hard for, say, an investment banker if they're still taking risk, or a fund manager, because you have a trading year, you have a target, and you've got to make money, the clock's ticking. So you're always under pressure. And even more so if you're professional, because you're sitting at the desk all day long, you're seeing markets move, you're seeing people making money around you. There's always the pressure.
Yeah, and I think for retail participants, it's probably the only job in the world where you could pay to turn up to work. You might not make money that day. So in terms of, you've come to work, you've sat at your desk, you're going to start trading. If you lose money that day, you've essentially paid to go to work. You haven't got paid that day. So it's kind of one of those professions where, if you said to someone, would you pay to go to work? Most people turn around and say no.
But then as well, if you don't have another income as a retail trader and you're purely trading, then you have the added pressure, you have to make money. And that's when things start to fall apart, because you start to force trades as well.
Yeah.
So it comes down to discipline, the way I see it. And I've done a lot of back testing when we're at the fund, automating strategies. And what I do now, if I have a fundamental view, I'll always wait, and I like the moving averages. I like the shorter dated moving averages. And
I'm going to touch on that, what indicators you find the most reliable. So, what ones would you say that, are the most reliable to you, and, why do you use them?
Going back to what you said earlier about professional traders, do they use technical analysis? Well, if you just look at the automated hedge funds and the CTAs, they're also known commodity trading advisors, the number one strategy they have is trend following. And that's a top strategy of professional traders as well, which comes down to technical analysis.
Yeah. I mean, do you think it's hard for people to, grasp that? It's like the the trend is clearly up. But then why do so many people pile in and try and short the market? Then they go so against the trend, and then they get burned.
What I find interesting is that retail traders maybe scorn technical analysis, yet they're willing to buy a stock that they know so little about compared to professional investors. Whereas one advantage or one area where you're at least on an equal footing is looking at the price action. And at the end of the day, the only arbiter of your P&L is the price. Price goes up, price goes down. And people do pile in to stocks that go down, and they think it's cheaper, but they get drawn into an initial narrative that it's a good stock because someone said so on social media, and they try to justify it with X, Y, and Z, but they haven't seen the other side of the picture is someone selling that stock because they don't think it's a good stock.
And then that's, confirmation bias as well, right? It's so interesting. And then, during your career, you had your ups and downs, your highs and your lows. I mean, how did you handle those emotions through trading? Because your P&L's up one day, it might be down the next 5 minutes. Trading is such a volatile, market industry. Your P&L fluctuates throughout the day, especially if you have no risk management. But, from yourself, how did you, handle the emotional highs and lows?
Firstly, so later on in my career, as I had a process, then you have confidence in your process, and over time you make profits. But earlier on, you just have to get back and get going. And it's an interesting thing with the hires we do here. We quite like to see people with a sporting background. 2 reasons. Firstly, because they analyse how to keep improving, because they want to be the best. But secondly, they've had losses and they can deal with it. You learn to deal with it in sport. What we also see lots of CVs is people coming in with 3 or 4 A stars that have passed every exam that's ever come to them, but they've never had to deal with failure in any way. So it's a case of accepting it and, more importantly, learning from it, and then journaling or whatever you need to do to build a process that you can move on and become more consistent.
Do you journal? Or did you journal?
I do, definitely.
Yeah.
And yeah, absolutely, definitely. And that's how you learn, because otherwise you tend to remember the wins and you put them down to your good skill. You forget the losses and you put them down to the market or the Fed chairman or a Donald Trump tweet or whatever. Blame someone else.
It wasn't your fault. Your entries, it definitely wasn't the entry. It definitely wasn't your bias on the macro fundamentals. It was definitely, someone else's fault for that trade down wrong.
But it's an absolute bias. And the easiest way to relate to that is you look at people, sports fans, or my kids play rugby. The amount of times when they lose, the referee gets blamed. But when they win, it's because the team's great performance.
Or they had a great game. It was their momentum in the game, or their impact on the game, rather.
Absolutely. But no one ever blames the referee for helping the team win.
No.
And that's a good example of the biases that we have. So journaling, really important to highlight what you did right, what you did wrong. Everything from position sizing is critical. Where your stop was, if you learn if your stop was too tight, what your process was, if you stuck to the process. And there's another key bias that we have, or lack of discipline, is sometimes we won't stick to the process. In fact, it's very common. You just read the famous book about the turtle traders, Richard Dennis and William Eckhart, and they had a process that consistently made money, and they trained juniors, and a handful of them couldn't stick to the process.
That's so interesting. So a profitable strategy, which was done by a handful of traders, you give it to someone else, do this exact list, do it, check, you're in, and they couldn't do it. They can't follow a simple instruction.
Yep, you think it's everyone's dream come true, but even then people can't follow it.
But it's like, okay, well, if someone psychologically, let's say that, they're up, 2% on their trade, but their target was 2.5, right? It reaches 2.5, but they won't close it. It's up 2.5, it's going to go to 3. It might go 3.5, 4. And then they hold it, and then it comes back down and they get stopped out. And then they go, right, well, okay, well, I'll take profit on the next one. And it's just not following back to what you said at the start, right? Not sticking to a process, not doing the checklist and, going outside of your comfort zone there, or not sticking to what you know best. That's when, you start to get into trouble.
Yeah, and we're also hardwired to cut our winning trades and run our losers. There's loss aversion. So a good example, let's say I buy a stock at $100 and it goes up to 105, 108. Typically we want to close it out because we want to lock in and crystallize that profit. But if it goes down to 92, 90, we don't like accepting the loss. So we hold it and we start to then gamble with it. And then if it goes back to 100, then we close the position, we get out, and we feel a sense of relief. And what we've done is the worst thing possible because we've been rewarded for holding the losing trade and we sold it when it was going up. And of course, what that means is next time we have a losing trade, we'll hold it. We'll think, well, I'll get out when it's flat. But of course, sometimes it will turn into a Bear Stearns or a Lehman or an Enron.
So interesting. We could sit here for hours and, dissect all of this. And I know, for clients out there, James will be doing, morning coffee clubs where he'll be coming to the office. You're more than welcome to join. Reach out to your account manager to get more details on that. There's also going to be the educational series that he's got going and also seminars and webinars. So we'll definitely keep you in the loop with that. But back to the risk management. I just want one more thing on the risk management. Is there an example where, your risk management strategies saved you from a significant loss?
There's definitely examples where lack of risk management didn't save me from a significant loss. And that's how you learn the hard way. But definitely every time a stop has been triggered, then it saved you from a potential significant loss.
Yeah.
As long as you execute, the stop's executed, you're out of the position. And the other thing it then does, it frees you up to think about the position with a clear head.
Yeah. What would you say your biggest mistake in trading was? Is there something that stands out to you? Your one mistake that, right, I really messed up there. You lost X amount. You didn't follow the risk management strategies. Anything that stand out?
Well, my biggest loss was actually at the start of the financial crisis, not because we didn't see a financial crisis coming. Completely opposite, we did, but I had too big a position on too early.
Why?
And I was trading New Zealand bonds, New Zealand interest rate swaps at the time. Yields are up towards 8%, and we could see the financial crisis slowly unraveling. And was slow. It took weeks, even months to unfold. But you want instant gratification, herd mentality across globally. We could see it across the bank, across our desks. Fear of missing out and too big a position. And I remember exactly that one headline came out from the Federal Reserve saying, we're monitoring the situation, ready to act if necessary, which was confirmation that the Fed was concerned. But the equity market took this as a green light. The Fed were going to cut rates. So equities went up to new all-time highs again.
Wow.
And stopped out of position with my biggest loss. When the frustrating thing was, it was the biggest move of my career. So later went back in with a small position after being burned. And of course, then smaller position, rewards are much smaller. But then you can then you can scale into a position when it's trending your direction. But position on too early, big loss, as opposed to waiting till the price action confirms and then scale into a winner.
Your bias was there. You was right on the idea. It's just the execution wasn't.
Overconfidence, herd mentality, too big a position.
Wow. Well, we're going to go do a quick fire round now. I'm going to fire some questions at you. First thing that comes to your mind, what your responses are, okay? So, favorite trading book?
The Market Wizards books, the interviews with a famous...
I think we're going to have to get you on there. We're going to have to talk to Jack Schwager and get you feature on there. So
no, that's the famous traders.
Favorite trading film?
I guess The Big Short.
Yep. Great one. Favorite technical indicator?
Moving averages.
Favorite economic data release?
Payrolls, US non-farm payrolls.
Even now?
Data. Especially now.
Okay. Technical or fundamental? You've got to choose one.
Technical.
Okay.
Simply because fundamental, I studied economics at university, but quite often I'm wrong, or you have the view, you see it too early, but the price is what determines your P&L. So it has to be price action, has to be technical.
Favorite asset class?
I would say interest rates.
Okay. Fixed income, wow. And then your favorite market? So NASDAQ, is it a 2 year, is it a 10-year? Euro dollar?
Favorite product? Overnight index swaps.
Okay, OIS. One market you avoid at all costs, you never trade it?
Single stocks.
Okay.
I may invest in them long term, but I won't trade them short term.
Interesting. One word to describe your trading style?
Momentum.
Like it.
Or trend following, but that's two words.
We could put a hyphen in the middle and we could just make that one. Most memorable market event? So it's probably the one that you spoke about before, right?
Yeah, but there's so many good
Or give us another one. Your most memorable market event?
I remember 87, I was at school when it happened, but I remember it, unfortunately, then it was reading the papers the following morning and seeing the share prices going down. 94 bond crash, long-term capital management, Russia default, Asia crisis, that was 97, 98. We used to have these crises so regularly.
And now you're really showing your age now.
Yeah. I did say I was at school at the time. I was living in New York in 2000 in NASDAQ bubble. That was pretty, I was going to say exciting times, interesting times.
Yeah. If you were to have a trading nickname, like on the trading desk, what would it be, or what was it?
Oh, I don't remember.
Oh, come on. We could take it out if it's not. Come on.
Don't remember.
Oh, okay. Okay. What was what was the best nickname on the desk?
There were great nicknames. I was lucky enough to, worked in London, Tokyo, New York. There were some great nicknames. The favourite one would probably be the Sheriff of Bottingham.
Sheriff's a good one. Fast Eddie.
Fast Eddie, yep. Turbo. Yep.
If you wasn't a trader, what would you be?
Well, actually now I'm doing the teaching and training, which I quite enjoy that.
Okay. Favourite trading quote?
I don't remember the quote off the top of my head, but it had to be around cutting losses.
Yeah.
There's certain quotes around that from the legends like Soros or Paul Tudor Jones, but the best traders, what the best traders do, they cut their losses.
Yeah.
So actually, interesting point there. If you look at statistics, retail traders typically have more winning trades than losing trades. But of course, their average loss is significantly bigger than their average profit.
That risk management.
Yeah. Whereas professional traders have less winning trades, but their losses are all small. So profitable trading is about small profits, small losses, and big profits. It's about eradicating the big loss. So as soon as you have a loss, you have to get out.
Perfect.
But the problem is, what if you believe the trade's right?
Yeah.
And what if social media is saying it's right, and the person next to you says it's right, and the newspaper says it's right?
It's all about that confirmation bias.
Exactly.
Everyone gets into your head.
But the only thing that matters that says it's right or wrong is the price.
Yeah.
And it's remembering that.
And then that's why you favour the technicals over fundamentals. So to wrap it up, I mean, what advice could you give to, your younger self or someone first getting into trading? What was your top tip be for them on, first getting started and, how to tackle the financial markets?
It would definitely be around studying the products, studying the price action, studying psychology, not just your own psychology, but the market psychology as well. And another point why new traders need to study so much is because at the end of the day, you don't know what you don't know. And people think they can read a brief book or do a quick course and then instantly they're a professional trader. But if you look at sport, for instance, the top tennis players in the world, the top all sports, they still have a coach at the very top level. And you have to keep improving and keep learning. And I'm still learning stuff, having been doing this for nearly 30 years. So that's why it's so important to just keep learning, whether it's technical analysis, behavioral finance, what's moving the market is changing every week, whether it's economics, fundamentals.
And that's what you kind of instill with our traders in-house, right? They've got a head of desk, then he's got the senior traders, then the juniors, and they all, mentor and, kind of help each other.
Absolutely, but the head of the desk is still learning as well.
Yeah, and then you're above them, trying to give your knowledge to them as well. Brilliant.
But it's so important. Yeah, even the top sports people in the world have performance coaches consistently enhancing what they're doing. And that's what we really focus on here at Onyx.
Perfect.
And we're going to be doing training on that as well. We have lots of training coming on that, but absolutely critical.
And that'll be available to our retail clients. So please do again reach out if you are interested in those products. And James, you do have your own show here at Onyx as well, don't you? The Macro Mondays.
I do Macro Mondays. We've been doing it for nearly 6 months now. It's
great way to get ahead of the week.
Popularity is going up, and we look at what do we look at there? We discuss the previous week's events and price action, the trends, upcoming data, and we bring lots of charts up with key risks, key trends.
Definitely gets you in the mind frame. This is what's happened the previous week. This is what's going to happen this week. Get you ahead for your trading week, and I think that's a wrap. But James, thank you so much for coming on for our first episode. If you did like it, please do like and subscribe. It does really help the channel. If you have any guests in particular that you would like, to be sitting here next to me, and any other questions that you'd want asked, please do mention in the comments or reach out to us, and we'll be more than happy to take a look.
So I guess, do you think this case marks the start of, I mean, what has it changed, do you think, in your view?
So I think the relationship between illness and covenants had never been considered before, and it's clear blue water with the other cases. But I think it also marks a general approach of the courts to be more willing to enforce non-competes.
So Adam, thanks very much for joining me today. This is your first podcast.
It is. First of many, no doubt.
Yeah. Well, it's unusual for us too, actually, to be discussing a legal case, right? Usually we're very much on market dynamics, that kind of thing. This was a big case for Onyx, big case for Dare and the individuals involved, of course, but there's for sure ramifications in the market, non-competes, contractual type things, and I'm sure there's a lot of eyes on this. There's Bloomberg reports and all that, and we can get to that later. But I guess just to frame the discussion, could you summarize in your view what this was really about?
Yeah, I mean, in some ways it's a straightforward case. What Dare wanted to do was to enforce the non-compete covenants that it had with its employees who'd resigned. So a couple of employees resigned, actually a whole tranche of employees, and most of them I think went to Onyx. But Dare wanted to enforce the covenants, and that's a standard sort of case where ex-employers are saying you've got to comply with your covenants. What was interesting and different about this case was that there was a long notice period, so there was a year-long notice period, and both employees, both defendant employees in this case, were off work, and they said they were ill through the notice period, so they weren't at work. And Dare said, well, it doesn't matter that you haven't been at work for that year-long period. We still want to enforce a year's post-termination non-compete afterwards. And that was the point that the court was considering, whether you can enforce 12 months plus 12 months in effect.
But is it, you say it's normal, but is it not unusual to be starting this dispute within the notice period? So having a case proactively to get people to adhere to things?
No, that's not desperately unusual.
Okay.
I mean, I've got a few of these cases on the go at the moment where people resign and then say, I'm not going to confirm that I'm going to comply with my covenants. And then the employer says, well, in that case, we're going to apply to enforce them.
Okay.
And there was another big case involving traders, actually jump trading case, where that happened. It was another year-long notice case. And the problem that Jump had in that one was that they waited until quite near the end of the notice period before they started litigating.
Okay.
And that caused a whole load of problems for them. But it's not, the fact that you go in your notice period isn't particularly unusual.
Okay. But to state the elephant in the room, though, what was it really about? What was really at stake in your view?
I don't know. What is the elephant in the room?
Well, that's because, I think it's very unusual. I certainly wouldn't have litigated. Once I've had staff leave, they leave. And you move on and you say, well, look, I've got to rebuild.
Yeah, okay. I guess, you're Onyx. And I suppose the elephant in the room for that case is that it was a business against business dispute. And so the vast majority of the cases that I do actually are about two businesses fighting and trying to prove to the other that they're the big dog in the
So in a way, not unusual, again?
No, it's not unusual at all. I mean, the employees are more often than not pawns in it. They don't play a significant part. And especially when they're highly remunerated, the new employer will be paying the legal fees more often than not for the employee and will be indemnifying them. So the employee's really not got that much skin in the game. And it's a battle between two businesses and they're both trying to stake their claim on the ground, on the terrain.
Because the case was officially Dare versus the individual.
Yeah, exactly. And Onyx weren't in it.
Yes. But I think the judge, I was amazed at how quickly it was essentially assumed that it was effectively Dare versus Onyx. That's the way it came across. Because I guess that's normal.
That is normal.
Yeah.
And I was in a case that went to the Supreme Court, which is unusual. In this area of law, what normally happens, if it gets to court at all, it gets to court for a contested interim injunction. And when the court grants an interim injunction with penal notice on it, that's normally the end of the case. One side knows it's going to lose, the other side knows it's going to win, and it normally settles. This case is unusual because it fought to trial, so there aren't that many trials. 99% of cases settle before they get to trial, so that's unusual. And the vast majority of cases don't go to appeal because they happen so fast and things are so time dependent. But I had a case which went to the Supreme Court, and there were 3 or 4 hearings in that at different stages, and at no time did the employee ever turn up. So it went all the way to the Supreme Court and the employee wasn't there. And everyone knew, the Supreme Court knew, it's not really about the individual, it's about these two businesses fighting out amongst themselves.
But the court ultimately did uphold a 12-month non-compete. But how did they, in your view, convince the judge that the information they had would stay commercially sensitive for that long?
What you've said is accurate. The court upheld a 12-month non-compete, but for one of the employees refused to enforce it, and that was absolutely crucial.
Okay.
So there's a whole series of questions that you've asked me there, but I think the bottom line, the sort of fundamental question is, why did the court say, I think this non-compete is potentially enforceable? I say potentially enforceable because the court did enforce against one defendant, Hikmet, but not against the other defendant, Solomon. So it was potentially enforceable because the court said that there was confidential information that the ex-employee had. Now, the classic way in which you justify a non-compete is to rely on confidential information. So the starting point is that all covenants in restraint of trade are unenforceable, and then it's for the employer to say it's protecting one of my legitimate business interests, and confidential information is a potentially legitimate business interest, and it goes no further than is reasonable. And it's for the employer to justify that, and for an employment restrictive covenant, the court looks at it with a degree of scrutiny. In this case, the employer said, I'm protecting confidential information. That's not the only way in which you can justify a non-compete, but that was what they did in this case. And there is a bunch of information that's confidential. And what happened, and I think to some extent the judge was persuaded because it all looked very technical. What happened was Dare said, look at all this information on spreadsheets and look at all this pricing information. And a different judge, perhaps more immersed in the industry, because this judge just didn't know anything about the industry before this case, made that clear. A different judge might have been a bit more sceptical about that information. But what the judge said was, even though you haven't taken any confidential information, you may be able to dredge it up from your memory in the future. And that seemed to me to be a very generous pro-employer
That's
approach.
what I was going to ask you.
Yeah,
the judgment
exactly.
was treating memory-based knowledge as confidentiality, which, is that not a slippery slope?
It's not unusual.
Okay.
It's not unusual to say the fact that you can remember something, the fact that you haven't got it in a document isn't determinative. So if you've got two employees, one's nicked a bunch of phone numbers and the other one has got a retentive memory and knows all the phone numbers, there's no reason why you can't enforce against both of them.
Okay.
Because it's the same information, they've both got it, one's just memorised it. But what's unusual in this case is that it was intricate information. It wasn't pinpointed what information the individual would remember, and the judge didn't care. He just said you could dredge it up at some future. He didn't even identify what it was that could be dredged up. So the judge took a very broad brush approach towards memory, which is, from your perspective, you're honest, enforcing these covenants, that's great.
Well, I guess because we are the complete other side, where we know, if anything, the technical detail very strongly and the best, and weak on the legal side, it was a complete reverse for us, because we're saying there is nothing. We can all recreate these. These are basic spreadsheets. We were trying to get this across. I mean, we sell these spreadsheets basically for nothing, pretty much for free, as a lead lag to our other services, because they're so readily available. And
Yeah, exactly. So I think a judge, the judiciary in general, they're lawyers. They've been lawyers for 20, 30 years, and they're now judges. They're impressed by technical spreadsheets. It looks complicated, therefore it's probably confidential.
On that kind of same point, what about the regulatory side then? Because that was something that was important to us because of the way we see, the exchanges, the brokers, the kind of setup, regulatory setup that we have right now. We felt very strongly that ICE in particular had a special relationship with Dare, and they didn't actually deny that. And then there was also the case with the brokers as well. And these are all against the kind of FCA rules, and we wanted to emphasize that. And I think maybe that was done perhaps with the other barrister by the Hikmet. I think you might have avoided that from memory.
Yeah, well, it didn't
factor into
it. Didn't factor. I mean, so we did take slightly different approaches. Niran De Silva, who was for Hikmet, did take more of a proactive approach on the regulatory front. My view was the judge isn't going to be interested in this, and he wasn't.
No.
And so I was right. I think it's not impossible that a differently formulated case with different regulatory background could work. So you could say, for example, your covenant forces me to act in breach of my regulatory obligations. Therefore, it's not in the public interest to enforce this. But I don't think the evidence in our case went far enough and wasn't clear enough for the judge to take a view. And what the judge didn't want to do is tread on the toes of the regulators, because that issue wasn't before him. And so he was being asked to make a decision on regulatory matters which haven't been pleaded, which hadn't been argued, which wasn't an issue in the case, and he just wasn't going to go anywhere.
And it would have set a precedent.
It would have set a precedent, and not necessarily the right one. The judge didn't want to go near that. So I think if you're going to take a regulatory point, it has to be, the case has to be stronger, and it has to be run that way from the start.
So I guess, as we said, there was two kind of sides to this, even though there were similarities, but the two outcomes as well. But what do you think tipped the balance legally and morally, I guess, between the two?
You know, it's not complicated. It really isn't complicated. I think the judge found that Solomon was ill and Hikmet wasn't.
Okay.
That's it. And so when someone's off work because they're ill, they're not simply, they're not refusing to attend. And for Hikmet, what the judge says is you weren't just refusing to attend, you were actively working for Onyx during the notice.
That's what he found?
Yeah.
Okay.
So he said you were dealing with Onyx, you were giving them confidential information, and therefore I'm going to enforce the post-termination restraint and give a bit of springboard relief in addition to that. So you get not just the post-termination restraint enforced, but you get springboard relief, which is judge-made relief, cancelling out the advantage for your wrongdoing. Now, I think this was a very odd decision in respect to springboard relief. Normally, springboard relief should be for a period of months, and this was for 4 weeks only. It's not clear why he made that decision, so it's not clear what material advantage was gained by Onyx or Hikmet by whatever he'd done. But the big difference between Solomon and Hikmet was that he said Solomon was ill and Hikmet wasn't.
So that's clear, but at the same time, if we're talking a kind of moral argument, effectively you're saying, I believe you, I don't believe you, and by inference, you are effectively a liar and this kind of stuff. Okay, but there was absolutely no, or from our point of view, no appreciation. I mean, the judge said at one point, the behavior around the resignation process was extraordinary. Again, kind of emphasizing that Ashley, I guess, didn't behave very well. But what about all the evidence about how Eamon and Jono and Dare had acted? There seemed to be no kind of appreciation of how awful that all was, and let alone, so that's one thing. But then add to that, you know, recording someone privately. When we talked about that openly when it first happened, everyone was shocked. I mean, that's not going to hold up in court. You can't use that. There wasn't even a mention of it. It was just completely taken as yeah. What was that about?
I agree with you. No one came out of this smelling of roses. And in terms of who won and who lost, I don't think Dare was happy with the outcome. I think they were spitting blood at the outcome.
You think?
Yeah, definitely.
But what else could they have got?
Well, they lost against Solomon.
Lost against Solomon, but he'd still been out for a long period of time. And in our view, it was just about keeping him out anyway.
But they didn't manage that.
But he'd been out for 18 months when he could have only been out for 12. So they kind of got, they got 6 months less.
I mean, I'm convinced they were furious about that outcome. I think they got it wrong. I think Dare simply misjudged it, and I think they probably were undermined by their legal team. Probably. I think their lawyers thought the outcome would be different to the way I thought. Right from the start, I thought, this guy's been ill, they're not going to enforce for a year. That's it. I think that's what this case is about. And I suspect Hikmet thought that too. I've been out and therefore they won't enforce. I think Hikmet was unlucky and I think the judge took against him. But it isn't really a case of who's behaved worse. That isn't what the judge is doing here.
But he did mention it. He did make an inference that he didn't like the way Ashley behaved.
Yeah, that's because he was considering a breach of contract claim. So in the context of the allegations against him, but there wasn't a counterclaim against Dare.
Right.
So you're not weighing up conduct in that way. Just because Dare had behaved in a way which you or I might not behave, secretly recording people, doesn't mean they still haven't got a breach of contract claim.
Should that not have been, on retrospect, in hindsight, they should have countered aggressively early about that then? They should have made that a contentious issue, like, well, hang on.
No, I don't think it matters.
Okay.
I think the law is that illegally obtained evidence is normally admissible. So if I break into your safe and find out lots of juicy information that I can use against you, the court doesn't say, but you stole it, so it's not admissible. The court lets it in.
I've been watching too many crime shows then, and US
US
law
crime shows,
because the opposite is what I thought. I mean,
Well, ask a barrister next time.
Clearly. Well, as I
or
say,
do a podcast maybe.
Yeah, it's good to know, right? I mean, this is the other thing for
I'm
me.
not suggesting you break into people's safes to get information.
But, you know, it's just because, I mean, taking all the legal side out of this, we as just people, employees, employers, you kind of have, and it's the same with regulation, you kind of live by a code that you assume holds you together, but it's really kind of fantasy until you test it. And this was testing it. So you have a contract. And by the way, for the longest time, you know, we've been trading for 13 years from our last place through to Onyx. And all throughout the way of signing contracts and writing contracts when we were the employers, it was always, these non-competes aren't really enforceable, but you can try.
Well, okay, I don't know why you say that. I mean, if that was right, I'd be out of a job. Because a lot of my work is enforcing non-competes.
Yeah, I think the way it was...
I win non-competes, by the way.
No, fair enough. It's just I'm just
if
telling
you want a barrister to win it for you.
Yeah, so that might be black and white, but then the next layer being like, and there's a certain way to behave. Clearly, that's not really true.
Well, I don't know. Judges are humans too, and if you've behaved, you know, there was a senior barrister in my chambers that always used to say, and he didn't use this word, he used a much worse word, but he used the bad person is the person who loses the case. And he didn't say bad person.
Yeah.
That's
not what happened though.
Well, it kind of is, because I think the judge thought, I think Hikmet's not telling the truth. I think Solomon is telling the truth. Therefore, Solomon wins, Hikmet loses.
Okay.
And it doesn't really matter how reprehensible Dare have been. I mean, that might have had an impact at some level on costs for Ashley Hikmet, not paying all the costs because of Dare's conduct. And it was pretty unpleasant. And you know, he might have been able to say, you've invaded my privacy at various points.
Right.
But it was in a public. He was recorded in a public area. I suspect when Dare used private detectives, they crossed the line. But I've got no way of knowing that. That was my gut feel. I've no idea. They may or may not have done.
Well, there are a lot of other employees who didn't end up going to trial who make that exact claim. But again, it's the idea that this behaviour is acceptable. You've just said it, I'm repeating myself, but it has no bearing on the case. And I think that's quite shocking to people. You expect there to be some kind of person or authority.
Yeah, I mean, there was no suggestion that the evidence they obtained was unlawful either, I should say. I mean, I've talked about unlawfully obtained evidence. I'm not suggesting they broke into anyone's safe. But the breaking into a safe is a case. So there was a case, a divorce case about divorcing couple one break into his, I think the husband's safe to show that his assets were much more than he claimed. But there's no suggestion that Dare, in this case, obtained evidence unlawfully. It's just a bit distasteful to record people's secrets.
Well, I was going to ask, so you talk about being undermined by legal representation. Do you think, though, some of the way this evidence was obtained was aggressive? You know, the kind of some of the exploratory things. I forget the legal wording when you demand to see people's phones and things like that. You know, every stone was
turned.
Not turned, yeah. And is what I'm trying to say is you kind of get what you pay for a little bit on that front. And these were this is Allen & Overy. This is the top, or at least the most expensive law firm in the UK. And I guess that's what you get. That's kind of what they can deliver you is bulldog type mentality, I guess. Is that fair?
They pressed hard, yeah.
Yeah.
I mean, the other trader case that I was doing the year before Dare was called Jump Trading. Allen Overy were on the other side in that as well. And that case they withdrew halfway through trial, so it went very badly for them. And I think they got burned in that. In that case, they did sue the new employer. I was instructed by the new employer, Verishan, who was in the Onyx position in our case, and Onyx weren't a party, so he didn't have a barrister. But they did. So I think what happened, A&O learned from changed their tactics because of what happened in Jump.
Right.
So they did bring the new employer in Jump, and they didn't in our case. And I think they should have done the opposite in both cases. So I think they're sort of learning or changing their tactics. I can't tell you that's right because I haven't talked to them about it.
But from my own
I think
experience,
they did a good job in Dare.
That's what I mean. I think from my own experience, and I unfortunately have quite a bit now, and it's just, there's no guarantee your legal representation is going to be willy-nilly doing everything you ask. They have their own view on things, and I think it was at least seemed unusual to get someone so aligned with you, like whether or not they believed in it or not. I mean, usually you look, Greg or company or whatever, you're overreaching here. That's not the way the judge will see it. We got a lot of that. The judge won't like that. The judge won't like that. I don't know if we didn't seem to care what the judge liked. They said, we're going to throw everything we can at you and see what sticks.
Well, I don't think it did work.
No, but it got, okay, I guess what I'm saying is it got a lot further than I feel like it should have done because of someone, and I was only there in person one day, and it was, you were quite clearly building articulate story and a logic train and, all this kind of...
I can't remember.
I was the first day in and was getting...
cross-examined. So I was cross-examining him?
Yes. But there was the other side also chipping in and wasn't interested in hearing the responses so there could be a dialogue that creates a story and an end point. It was accusation, and just, it's there now. And that seemed to be the approach. Just get everything out there and accuse, and don't worry about whether the whole thing makes coherent sense. At least anecdotally, that's what it seemed like.
You never know what the other side's strategy is. You don't know what their client is saying. You don't know what the solicitors are saying. You don't know what the barristers are saying. I think it was complicated leading up to the trial because there were lots of issues about confidentiality and medical evidence, and these were litigated hard, and it was and in private, and it was very complicated. These were complicated, complex issues, and there were disclosure issues, and it's easier when you're for the claimant to demand documents, I think, because as a claimant, you haven't got the other. So you're saying, I think bad stuff happened. I'm sure there are documents which exist, and the other side can't say that back. So it feels, you on the defendant's side, it feels like you're always under attack, and it feels like you're not advancing your case properly. And that isn't the reality of the position. But I understand how it feels like that.
Fair enough.
But I don't know that A&O were doing Dare's bidding and any more than the lawyers you had weren't doing your bidding.
We had very defensive lawyers, and we had the problem of having lawyers for each, and it was not even just these two, there's others involved, and they, on retrospect, they're obviously incentivized to keep things vague and keep things ongoing.
Well, I can see your issues. The problem was, from your perspective, the individual legal teams are acting for the individuals and not for you.
But even better than that, their client doesn't have to pay them. The company has to pay them.
Perfect for the client. Exactly. But so they've got their clients' best interests at heart, and that may not align with yours.
Right.
And your legal team didn't have a fighter in the ring, so there's only so much they could do.
Yeah, it was coordinating. It was a tough job. But I think from a legal strategist point of view, then I guess you've kind of answered already. But the evidence that actually wins or loses a case like this, you talked about the medical examination, the documents, the cross-examining.
Yeah, I mean, what was unusual in this case is the medical issue, the fact that illness was a factor in whether or not the covenants could be enforced. And I haven't come across a case like that before. I think it was a first.
Okay.
So there wasn't a precedent for that. And Dare were litigating it as if it was litigating the truth or untruth of the illness, whereas the judge decided that so long as there is a basis for accepting the employee's evidence, that's what the court should accept. So you don't have to determine whether or not, precisely what the illness is.
But then why was Ashley...
Because the judge didn't think there was a basis
for
determining he was ill. And what happened with Ashley was that he never actually saw a doctor. His dad knew a GP.
Right.
Ashley spoke to the GP once on the phone, never again. And after that, the GP just kept signing him off as sick, never having seen him for months and months and months. That's a regulatory problem. And the judge thought that's not good enough.
So I guess, do you think this case marks the start of... I mean, what has it changed, do you think, in your view?
So I think the relationship between illness and covenants had never been considered before, and it's clear blue water with the other cases. But I think it also marks a general approach of the courts to be more willing to enforce non-competes or to uphold them, and to say, in respect to confidential information in particular, it doesn't have to be that confidential or that persuasive to get over the threshold to justify a non-compete.
But isn't that at odds of what the government, or at least the Labour government as it stands, is trying to do? I thought we were trying to move away from non-competes.
I mean, is that what it's trying to do? You tell me.
Yeah.
I know that a few years ago there was a suggestion that non-competes would be outlawed or limited to 3 months. It's never happened.
Okay.
And the government's got enough on its plate
Sure.
to this. If I was the government, this would be way down my list of things I wanted to spend parliamentary time on. And what difference does it make? The truth is, the best person to decide whether a particular covenant is right or wrong is not the government, but the judge, having heard the facts. And I think that seems to me to be the reality, and that should be the right approach, and it is. That's what we've got at the moment.
And there was that whole thing about jurisdictions as well, because this is actually a Dubai office they were going to, but I guess that didn't matter. Or if they had gone to Dubai and started straight away, you would still be infringing on UK law.
Yeah. So there's an order of the court here with a penal notice. I don't know about enforcement in Dubai, but what you can do is what happens is they contact the enforcement officer in a different country and say they're in breach of a penal notice. And try and enforce. Or if the individual comes back here to this jurisdiction, they'll be in breach of the order, and an arrest warrant will be issued. And also, in a classic situation, as long as you serve the order on a third party, for example, a new employer, and the new employer has the order, if they induce a breach of the order, they're in contempt, even though they weren't a party. So you guys could be in contempt.
Gotcha.
If you're in breach.
And
so so long as you've got premises here, they can enforce against you.
And I know this isn't really relevant, but the US have talked about, or they have ruled, I thought, in some states that non-competes aren't even enforceable full stop.
Yeah. So some states enforce, some states don't enforce, and some enforce in a weird way.
Okay.
So it changes from state to state.
Okay.
And that matters because sometimes, that matters here, because sometimes people with, I don't know, Delaware or a Californian contract with covenants in come here and they want to try and enforce it here. And what the courts say is, well, we first judge whether it's reasonable on the basis of the law of England and Wales. But if it's unenforceable there, then it can't be enforceable here either.
And was that not relevant in this case?
No, because it was a UK contract.
Okay.
So you can have a UK worldwide contract. And the fact that it's... So I've got a non-compete against you, and the fact that Dubai doesn't enforce, for example, if that's the position, doesn't mean that the UK won't enforce here. It's coming the other way.
Just to quickly go back to the judgment, it was ambiguous, I think. I think that's hard to deny. And I guess in our mind...
What was?
The judgment itself.
Which bit?
Well, collectively, to say, okay, to give you an example, Bloomberg said, Dare wins the case. And then we say,
Bloomberg's wrong.
Exactly, and one of the first
they're
things...
wrong. That's not ambiguous.
Okay.
They didn't win.
Yeah.
Solomon won and Hikmet lost. So Dare won against Hikmet and lost against Solomon. That's the reality. There isn't an ambiguity.
So how does Bloomberg get that so wrong?
Got it wrong. Phone Bloomberg and tell them they got it wrong.
I did, actually. He asked me to quote. Whatever.
You can ask him to contact me if you want.
Yeah.
I'll tell him the answer.
No, he said, well, if you read on the article, it explains a bit more. Mate, you've put the headline, that's clickbait, like it's done. But anyway...
I don't think they did win.
Yeah.
So, Solomon made an application. The winning team normally gets its costs paid by the losing team. That's the cost follow the event in this jurisdiction. And we made an application for our costs. And we wouldn't have done that if we'd lost. So Hikmet didn't make an application for his costs. He was trying to resist paying costs. It settled. As you know, there was a global settlement before this was determined. But the fact that we were going to make a cost application indicates what the underlying reality was.
And again, the ambiguous part was we weren't sure, does that mean Stephen can start right now or not? That was also up in the air.
That's a really interesting question. I mean, the answer is yes. But what Dare did, and it will never be determined because it's settled before it came out, was say, okay, the court is not willing to enforce the injunction, but the contract is still enforceable. So we can't go to court and get a court order to enforce it, but the contract's still there. And if you're in breach, we can sue you for damages. And what Stephen said was, that's wrong. You've got no loss because you've got the benefit of me being out of work for that period of time. And they said, well, that doesn't matter because we've still got an enforceable contract. And so that issue was going to be determined.
So had it continued, this whole damages part would have been complicated as well then?
It would have been litigated. You know, I think it was pretty clear what would happen. But also, what happened was that Dare got an interim injunction stopping Solomon and Hikmet working pending the outcome of the trial. And at trial, the judge said, I'm not going to uphold the injunction against you, Solomon. And the price of obtaining an interim injunction is that Dare promised to give a cross undertaking as to damages to Solomon. I would compensate you if I'm wrong, because I've got an interim injunction. If I'm wrong at trial and it isn't upheld, I'll compensate you. So what Solomon had was an application to enforce the cross undertaking of damages as to damages against Dare. And Dare was saying, well, you've got no loss, but also we've got a damages claim against you. And we said, we have got loss and you've got no loss. So that argument was going to
would have been messy, but
would have been fun.
I guess final question then, if we'd appealed then?
Who? Hikmet.
Yes.
So we didn't have an appeal.
Didn't have to appeal, did you?
Well, you appeal an order, okay, you don't appeal the judgment.
Okay.
So you appeal the order. The order against us was, they sought to enforce the covenant, and the covenant was not enforced. And so we couldn't appeal that. Dare would have wanted to appeal it.
Okay.
We could have put in what's called a respondent's notice saying, well, we want to uphold the judgment for different reasons, like, for example, the covenant, we don't think the covenant's enforceable at all. But only Ashley Hikmet put in an appeal, and he had a whole series of grounds for his appeal.
How do you feel like it would have gone?
I think they were arguable. I think he would have got permission if it had gone forward from the Court of Appeal.
It just would have just dragged on a lot of costs, and
that's a good thing.
Yeah,
from a barrister's perspective.
From a barrister's perspective, but ultimately, you know, this was 18 months, and we settled, and I think we're both happy to do so. But you did say that they were unhappy. You think? I'm surprised to hear you say that, actually. But
well, I don't know what. I'm just a humble barrister. I don't know what the global settlement was. So you know more about it than I do. But I think on this case, I'm certain they were. I think they were spitting blood.
Good for you.
Yeah.
Adam, thanks very much.
No, great pleasure. Real pleasure. Genuinely.
Cheers.
Hi, welcome to Trading Corner. I'm joined with Raj this week at Raghav's in sunny Thailand. Lucky him. So yeah, we're just going to jump straight in. I think the main thing to really talk about this week is the margin. We've had a decent pullback. If I just show you this curve here, you know, we hit highs kind of, well, about a week ago, 10 days ago, highs of all year, and we've pulled back significantly. So I'd love to get your input on the middle distillate part of the curve, but some of it's also been attributed to crude. You know, we've rallied quite a decent amount now in Jack DFL, Jan DFL, which is all contributing to a weakening margin. But also, you know, the light products, they've also come off quite a lot. I think just speaking with Raghav over the last couple of weeks, there's been fairly consistent gas snap selling. I think the flavour of the last few days has been a lot of naphtha selling. So more compression on like the tails of the margin. So yeah, it's just the middle distillates has been the main story of the year. The relentless strength, you know, we had the lack of the draws over the summer, we're going into winter and we've finally got this cold weather. Is the market, I mean, I think I know what you're going to say, but this is where you'd expect the gas oil stocks to be drawing and actually the crack starting to hold up. Absolutely. How is it playing out?
I think if anything, we've seen a clearly very exaggerated effect on the gas oil part of the margin curve. But so far, really, the big spike in the sell-off is probably more related to the sanctions and the Russia-Ukraine story. So starting off with last week, why we saw the spike was arguably just tighter ICE guidance on what they were going to do with regards to accepting any cargoes for their assessment from other countries. So far, the European sanctions have been taken a little bit lightly and maybe the enforcement has been a bit lax. But this time around, ICE have basically given us very strict guidance on what they will allow into the assessment process for gas oil.
This is important for just expiry or for every window?
This is for every window. This is gas oil in general.
Okay, so yeah, exactly. You know, you have contracts, swap contracts, so it's priced against the paper contracts, but also the physical cargoes. So if you're limiting the amount of physical cargoes that can go into the window, of course we're going to rally, right? It does make sense. Exactly. So now we've sold off of it. Is that because, you know, perhaps ICE are having a bit of, you know, pushback on which cargoes are allowed in, or is it purely speculation on the political stuff?
Nothing has changed from ICE's end so far. If anything, maybe the sell-off started to ease a bit once some of the shots had been squeezed out. But a large bulk of the sell-off is probably attributed to Trump's comments about Russia-Ukraine potentially easing.
Yeah.
And even though the odds on that aren't really spiking at the moment, and there's been a little bit of pushback from the EU and Zelensky on this, what we're seeing is perhaps a sentiment-led sell-off. Nothing has changed on the assessment end, so we still have very tight guidance from ICE on what will be classified as a Russian-derived fuel product or a gas oil product. So yeah, it's mostly sentiment-driven, I'd say.
Wow, it's a bit crazy, isn't it? I mean, it's definitely worth talking about this. Trump, I think it was the 28-point plan or agreement that they released last week. It's very, you know, not to get too political, but it's an aggressive agreement, and I think everyone's just in a tight spot where, you know, it could very well be agreed. I don't think just because of its aggressiveness that we should totally rule out the fact that we're going to come to an agreement. As you're saying, like all of the you know, the feelers in the market, people aren't expecting Ukraine to sign this deal, but it's getting to a point where they are feeling quite exhausted. So perhaps there'll be some amendments to make, etc. But either way, it does, you know, the last 3-4 months, it has felt as though this is all starting to draw to an end. And that's going to be massive for the oil markets. You know, if we do get all this crude coming out, all this LNG, a lot of, you know, gas, all the products, everything, you know, obviously the refineries will take some time to come back online. So it's mainly the feedstocks, crude especially, it's going to hit the market hard.
Absolutely.
So yeah, it'll be super interesting. But yeah, just just on the back of that, also, we're going into a period of, potentially lower liquidity with Thanksgiving coming up. There typically tends to be some kind of funky price action when the market's out. So let's see into this week. I think you just have to be a little bit cautious that with that lower liquidity, there might be some aggressive price actions. Okay, interesting. So gas oil giving up a little bit. I mean, let's see. The market might buy into it. We are drawing stocks, right?
Yes.
So the underlying market is still fundamentally very strong. It's just a potentially repositioning.
Yes, absolutely. But I guess the overall levels themselves can't be ignored. We're still very, very high on a crack basis on distillates. The US still remains strong. There should be strong seasonal demand around this time of year.
Yeah.
So there is strength in the market, but perhaps it's just been exacerbated by the headlines.
Exactly. And also, you look at any chart like this, this sell-off looks crazy. It's huge. But we have come off from $14 margins, which are enormous, to still almost $10. Still very profitable for refiners. Still the cracks are very strong. So even though we have given up a lot, there's still a lot to go before you see any material change to the run rates. So I don't think that's obviously going to happen anytime soon. But crude could be a slightly different picture. We came from a max bearish environment on the prompt crude cargoes to now a very strong forward curve. So we need to see a lot of physical demands coming out this week and next week in order to hit the forward curve levels, which I'm a bit skeptical about. There were rumours that a lot of the oil that was eventually cleared was put into storage. So we might see that re-entering the market this week or next week. But to go from diffs of minus 150 on 40s to plus 60 cents in the span of 10 days, I think it's going to be hard. So let's see. It feels like potentially we're going to start topping out on crude in dated, at the least at the minute. Okay, so that's Europe. I mean, it doesn't look like anything too interesting. Obviously, we've had the margin pullback, crude strengthening. Potentially will give up some of that crude strength in the next week or so. Asia, how's Asia looking for you guys?
On the distillate side, it's mainly been a Europe-led rally. We've had some pockets of demand from Asia, but really most of the moves have been just on the back of ICE gas oil. So we've had the spreads strengthen with ICE gas oil and then sells right back off with ICE gas oil.
And how about the East-West?
That's the one thing I'd say has become a little bit decoupled from the price action that we've seen so far. Because what we've seen has been the cracks absolutely ripping and then selling straight back off. But the East-West still remains a little bit suppressed. Arguably, this is down to the physical flows, since a lot of gas oil produced in Asia might not make it into Europe as a result of these sanctions. It just means there's going to be a bigger backlog of cargoes in Asia having to remain either in the region or being pushed into LATAM. So what we're seeing is East-West at very low levels. So, even things like the East-West boxes, the 1-2 East-West box, it reached historical lows of 11.5. That is minus 11.5, which is, Russia-Ukraine levels, at the start of the war. So we're just seeing a very, very suppressed complex as a result of potentially more cargoes being stuck in the region.
Wow, interesting. So I guess the next big event into, you're talking about Q1, Q2, into the new year will be Chinese New Year. So perhaps that might bring back a little bit of product strength if refineries start to potentially pull back on their run rates or something. But yeah, that is low. Wow.
Yeah.
Okay. So, I mean, the freight rates are still fairly chunky. So you kind of do understand why those East-West do end up softening a bit. But for us, for Brent to buy, I mean, the curve is just totally paralyzed. So very little price action. It looks like it is the most stable curve at the minute. The dated Dubai contracts are more volatile than the Brent Dubai contracts. So it is really suggesting that the East is not too fast to position here.
Yeah.
And then you have the US. So into Thanksgiving, arguably, the liquidity will drop off. Perhaps we'll get less interest in kind of cargo fixing, etc. But the curve also, relative to Brent, still looks fairly low. So Brent is really, at a strong premium to all other regions. No real reason why. So I think we'll probably start compressing in those kind of geographical arb levels. But again, you know, if everything gets resolved, we should see freight get hit, we should see crude get hit. I think the environment, you know, could get quite crazy. So yeah, it just needs to be aware of it. The only other thing I wanted to point out is, again, you know, we get all these headlines, etc. Russia, Ukraine, all the sanctions, you know, was meant to hit, I think Thursday was the deadline. Still, flat price is fairly low. You know, the front Brent spread is pretty strong, actually. I think it got up to around 63 cents. We have expiry on Friday, so let's see who's looking to buy the cargoes there. But given that potentially a lot of oil is offline, flat price looks low, which means that the market doesn't really think that the sanctions are going to hit as hard as the market has suggested. But let's see. I think there's still a bit of time to kind of get around the logistics. Okay, so I guess, you know, as I said, we're going into Thanksgiving and then Christmas season, so it's probably quite difficult to put on any meaningful trade. But if you had to suggest something, what would you go for?
Probably on balance, the one position I'd look to kind of put on would be slightly more deferred. If I had to pick something, maybe around the Q2, Q3 region, maybe some longs on the gas oil East West, simply because the prompt has been, you know, pushed to such distressed low levels.
Yeah.
It might provide a good entry on the deferred East West, and potentially might even, you know, provide a little bit of time for things like Russia, Ukraine to get resolved, which then would lead to the East West really ripping in that kind of region.
Yeah. So what levels are they at right now?
So right now around minus 22, minus 21 on the 2Q gas oil East West, for example.
Okay, so still great at entry levels.
It is still a great entry level. You could see, you know, if Russia, Ukraine gets resolved, we're talking about, you know, single-digit East-West numbers. So quite a lot of upside there. Okay, great.
And for me, so last week we went long DecGen dated. So I'd look to exit that now. I think it's had its run up. And a little bit more niche, I think I would go for either a short dated Dubai contract or a short structure index. So something like 812 2-week. I would short, or 812 Caldec. Very specific to dated, but generally, you know, if you short a structure like that, you're suggesting that perhaps the physicals reached towards the higher end of the level. Cool. Well, let's see how we are in a week's time. Thank you.
Good afternoon, and welcome to today's European Market on Close episode live from our London office. And oh my, dated. Look at this. Here is our trade bid and offer summary as recorded by the officials. As you can see, if we look here at the screen, today the trading session was mental. So we had Totsa. I was actually bidding for 9 to 13 Midland constantly, and then Vitol hit their offer, the bid at the 170 overdated. Elsewhere, Totsa, Glencore were actively bidding, lifting the curve very high compared to what was assessed on Friday. Whereas on the sell side, we had Vitol, Petroineos, MVP all offering, but the offers weren't as high as the market would like to trade. Now on 40s, we had Ganvor, Totsa again bidding, shifting our 40s curve. Remember, our 40s was negative or even up to zero, the highest level on Friday. So 70-80 cents higher. That's a really big shift. And for example, we also had here Brent was being bid for the first time in a while Ecofisk as well at 140 overdated. So big moves in the physical differential today. And let's do a quick recap. So on Friday, the officials assessed the physical differential at minus 26 cents. And today we expect the physical differential to hit positive for the first time since actually the beginning of November. So that's big news. The structure in dated Brent and the dated Brent complex looks like it's gaining some upward momentum after this bull play, obviously from the likes of Totsa and Ganvor. But elsewhere, except the North Sea, let's look at what's happening in price action, the futures, and overall in the market. So key themes right now, obviously, is the peace negotiation between Ukraine, Russia, and the US that's coordinating this peace deal. But Brent hasn't really reacted that much. At least it didn't react that much in the morning. And we've traded comfortably in the 62 range, as we can see here on the chart. So the market is fatigued. They don't want to trade any news right now, and they want to see something concrete. Obviously, if this were to materialize, Brent wouldn't be trading at 62, 63. It would be trading way lower because Russia is a big exporter of crude. And if the sanctions were to be removed, that's something bearish for the market. But talking about crazy things, here's the prompt spread, currently trading at 63 cents. Despite the softness in the prompt Brent futures contract, we are trading comfortably in the mid to low 60-cent range, and that's very high. As we can see here, that's the second highest of the month we've noted. So it's looking very, very strong right now. Refinery margins are going down, so traders are actually wondering what's going on here, because we should expect this to come a little bit lower. Even traders are expecting this to go lower, and it hasn't actually done, quite frankly. But elsewhere now in the market, what's really interesting that the officials are hearing from sources is, if you remember, the Novo terminal in Russia that was hit almost 10 days ago is actually now, according to our sources, the last 3-4 days has been shut. And that's because the FPS, the Russian agency, it's over security concerns. They're investigating what the ships have. Obviously, the port was attacked by Ukraine 10 days ago. It's a big terminal exporting around 700,000 barrels of crude and around 400,000 barrels worth of products. So we need to see how this plays out, but we're hearing from other sources as well that other terminals in the Black Sea are being affected. Obviously, no official communication by Russian government or anyone Russian related. They've kept this slightly under the radar, but that's very big news for the market. So the official spearing eye, as we will see later in our report, is showing elevated activity, especially ships queuing up outside the port. So that's something to keep an eye. And obviously, make sure you look at Twitter, LinkedIn, the officials reports, and obviously at the Flux News terminal and YouTube channel to get the latest updates. Thank you for today, and see you tomorrow at the Singapore Market on Close.
Bye.